10 months or so. It's almost conceding that the weak data we might be getting over the next several months or so is someone else's fault. So is there a date at which it's no longer the Biden economy? I'm serious. I mean, this was actually something I was thinking about over the weekend. You know, how long, what's the expiration date of blaming Biden and going back to that every single time? From the NEC director, Kevin Hassett, when he joined us after payrolls, said something similar. The economy we're inheriting is not as good as people think it might be. So are they going to embrace the weak economic data and say, look at how terrible it is? We can come in and salvage it with... We'll see. Michael Zeese of Morgan Stanley. Michael, thank you.
Thank you.
Equity futures right now, session highs up by 0.6% on the equity market. Chris Harvey of Wells Fargo joins us next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures positive here, starting the week in the right way, up by 0.5% on the S&P 500. On the Nasdaq 100, up by 0.75%. The Russell bouncing back from some steep February losses. We're up by 0.9%. Check out Europe. Look at this rally. The equity benchmark in Frankfurt, Germany, the DAX, record high, up 2.4%. Over in Paris, record high. The CAC 40 up by 1.4%. Year to date, In Paris, France, we're higher by about 12%. On the DAX, we're up by 16 percentage points. It's March 3rd. What a rally we've had. 2 hours away from the cash open stateside. Manus Cranny, some of the moves we're seeing in the defense sector, just phenomenal.
Jonathan, let's kick it off with Rheinmetall. This is one of the big German defense players. This is about a wholesale re-rating of what Europe will spend on defense. And boom went the European producers. JP Morgan raised their price targets across the sector, anywhere up to 25% up on the price. It's about turbocharging European rearmament, and it is manifest there, up 12%. Roll it over, have a look at Capri. We've got reporting that Prada are close to a deal to buy Versace, 1.5 billion euros. Capri bought that business back in 2018 for 1.8 billion euros. And just take your mind back to the autumn, the FTC blocked Tapestry for bidding for Capri, and it was down 45% on the day. So we're better bid there. MicroStrategy, 3 beautiful words from the president: crypto strategic reserve, and boom goes Bitcoin and the rest of the complex as well. We're up 13% this morning as President Trump on Truth Social talks about this crypto reserve for the United States of America. And it's a family of reserve: Ethereum, Ripple, Solana, and Cardano. Jonathan.
Manus Cranny, thank you, sir. Appreciate it. Hard to keep up this morning with some of these moves. Let's start in Europe. Equities racing away in the bond market. In Germany, the 10-year bond yields are high by 9 basis points. Lisa, further out along the curve on a 30-year, up by 10.
This is beginning to price in what a 900 billion euro defense and infrastructure fund might look like in terms of financing. I just wonder how far we're moving into conviction that this has any chance of going through, given the fact that there still is, really this incremental feel to some of the shifts that are going on. I mean, the EU, the idea about cars not having to comply with CO2 mandates highlights just how many small things have to go before you start getting even bigger discussions, really, in a serious way.
And I've said this once already this morning about something else, but the chances aren't zero, and the chances went up. It's kind of the European story right now, right?
Well, so this is actually raising a question of the bar isn't just really low anymore, but it's not exactly high. Mohamed El-Arian saying it doesn't exactly make him optimistic about Europe. Maybe it just means that there are more questions elsewhere.
Big move in the equity market higher, in the bond market softer. Yields up. On our radar this morning, President Donald Trump's first tariff deadline looming tomorrow. The U.S. preparing to slap 25% tariffs on imports from Canada and Mexico and double a levy on China to 20%.
So there's a big question, really, not so much on China when it comes to the additional 10%, bring it to 20%, but on Canada and Mexico, because Howard Lutnick called the situation fluid, which means they've been in negotiations. We've seen a flurry of diplomacy with Mexican officials and Canadian officials coming to Washington, D.C. I was in D.C. last week. They were all there trying to come to an agreement. But then Mr. Lutnick said in that same interview, tariffs will go on Tuesday. I'm just not sure the level.
So what is the level? Clearly, why did he say that? If 25%, and also he said something else that was interesting to me, and you mentioned it too. He said we need to negotiate with the teams. He's part of the team, and then didn't give us any colour whatsoever. He made it sound like it was someone else's call, plus the teams that negotiated with it, even though it's his team.
It feels a little bit like cats in a bag, and there are lots of different views, and clearly that's the case.
It's as if the President of the United States has actually not decided yet.
I get the feeling that he hasn't. And tomorrow's a big day. It could be 25% on Mexico and Canada. And the very fact that we're just accepting that it's going to be another 10% on China, and that's okay because there's a bigger thing out here, is kind of where we're at.
There's also a feeling that we don't know, and we don't know what we don't know. And honestly, at this point, companies just aren't doing anything. And again, how long does that uncertainty be prolonged, and at what point does that have an economic toll?
More on the trade stories. We approach that trade deadline through the next 24 hours right here on Bloomberg. Need to get you the latest on foreign policy. Israel halting humanitarian aid to Gaza after a 6-week truce with Hamas expired. The move coming after Hamas rejected a new U.S. proposal calling for extending the ceasefire through Ramadan and the Jewish Passover holiday.
So Steve Witkoff, the president's envoy, wanted to extend the first phase of that ceasefire. And Hamas says, no, we should be moving into phase 2, which means Israel needs to leave. And Israel's like, we still have hostages there. Not enough has been done. So now they're halting humanitarian aid. This is becoming very problematic for Qatar, for Jordan, for Egypt, which are saying that aid needs to go through because we're the ones that are dealing with the influx of Palestinians. This is another massive issue that this White House needs to be dealing with at the same time that they're dealing with what happened on Friday in the blow-up in the Oval Office, dealing with Europe and Ukraine. Just another laundry list of conflicts and issues around the world.
Just getting an update from the Oval Office, from the White House. Trump to make an investment announcement today. It's on the schedule for 1:30 Eastern time. We'll get some more details when we have it. I imagine that might have something to do with the tweet over the weekend about crypto, possibly, potentially.
The issue with the crypto, a lot of even conservatives are saying, what is this about? Why is taxpayer money going to be funding this? Can this potentially devalue or lessen the importance of the U.S. dollar when you're talking about a strategic crypto reserve? Lots of questions we did not get. All it did, though, is fuel a lot of speculation in this market.
Certainly an opportunity for the press to ask some questions about that trade deadline. That's taking place at 1:30 Eastern Time. Wanted to squeeze this in. Singapore investigating whether Dell and Supermicro servers shipped to Malaysia contained NVIDIA chips barred from China. The case highlighting the role of middlemen in funneling high-end semiconductors. They're not letting this go, and they shouldn't let this go. How are they getting into China?
Well, and it raises this question of how Singapore, as well as Malaysia and Vietnam and Thailand, try to get on Donald Trump's good side so that he doesn't force them to make a choice about whether they're with China or whether they're with the U.S., because they have benefited from this sort of fissure. They're going to act hard on this so that they can avoid the wrath and the consequence of this White House.
Just how export compliant was DeepSeek? Keep going back to that, don't we?
Front page of the Wall Street Journal this morning, NVIDIA AI chips reached China despite the U.S. ban. Traders in the country are selling computing systems with NVIDIA's Blackwell chips installed by routing them through third parties in nearby regions. So the export controls I think you're going to see out of this administration is going to be focusing on allies and foes of the United States if they're not compliant with those export controls. And there's a way that on the black market they're getting into Beijing.
That's the latest on chips. Let's turn back to the equity market. Equity futures rallying stateside. Over in Europe, a rip-roaring rally. Chris Harvey of Wells Fargo writing, in a lower oil, inflation and rate environment, we would expect a very different investment set from the last 12 months, namely, rest of the world over the United States, value over growth, and cyclicality over momentum. Chris joins us now for more. Chris, good morning.
Good morning.
Let's start with the US versus the rest of the world. What a rally in Europe.
A heck of a rally. So I was there in October, and sentiment could not have been worse. And everyone's saying it's so bad, should we be contrarians? And everyone wanted to wait for the election, and I think they waited for the election, and then bang, there we have it. But I think the real catalyst is you're finally starting to get some optimism around Russia and Ukraine. And you get optimism around Russia and Ukraine, you can see an environment where oil comes down, inflation comes down, and rates come down. And that's really positive for Europe.
Just quickly then, it's not stimulus dependent. This is something else potentially.
No, it's not stimulus dependent. So what we look at is the administration really does want lower oil, because what does lower oil do for them? Lower oil does, I think, put weight on inflation, it puts weight on interest rates, and that is something that they really, really want. So it makes Ukraine, a resolution in Ukraine, a big priority. But the funny thing is, the Europeans probably benefit more than we do.
Is the bar still low for some sort of positive development in Europe, or is the bar now appropriately set?
I don't know if it's appropriately set. I think people are still skeptical. The fundamentals are pretty attractive, or if you look at it, what do we have? We have a situation where you have good valuation, the economy is not so great but can improve, the ECB is still cutting or still in a rate easing cycle, and then you have catalysts on the political and possibly on the energy side. And by the way, the currency has been devalued. So that's a pretty good combination. Yes, it's pop, but that place has been a malaise for a long, long time.
How much is this just that people don't want to think about the U.S. and try to unravel and untangle the complicated story that is momentum unwind maybe, that might be a growth scare, but not really, but might be something with respect to uncertainty, but maybe just something that's a hangover from the past? I mean, find your narrative. It's very confusing.
You can pick it, because when you were talking about that, I was like, should we talk about momentum? Should we talk about Europe?
But that's my point. It's a flood the zone kind of thing in the White House. When you hear people talk about the stock market, honestly, it's tortured because people feel like they have no conviction about anything, and it's hard to get sort of an angle. So is that the reason why people are going outside the U.S., because they just don't want to think about it?
I think to a degree it is, but again, you do have those catalysts. And more importantly, let's just kind of talk on something that it's very hard, as you're pointing out, it's very hard to handicap the macro, right? We can talk about tariffs as much as we want, but we don't know what's going to happen. What we tell people is the only way to hedge that uncertainty is you need a certain allocation to low volatility in order to hedge that uncertainty. And so one of the things we've been counseling our clients with is, in your portfolio, you need an allocation to low volatility. And low volatility is one of your better performing sectors and groups year to date. And I think it will continue to perform, and it will continue to help out that portfolio, because you need to be able to stay in the game until we get resolution on a lot of these things. And it could happen in 3 weeks, could happen in 3 months, could happen in 3 years. We're not sure.
Let's talk about the tariffs tomorrow, because you think this administration wants lower oil prices. But if that's true, then why slap 10% tariffs on Canadian oil when last year we imported more than 60%? of oil from Canada.
Anne-Marie, and that's a $64,000 question. It's a great question. Are they using tariffs? What exactly are they using tariffs for, and what exactly do they want? We think they're using tariffs more as a cudgel to get certain things, whether you're going to pay a tribute, whether you're going to get some concessions. Really, tariffs are not about generating revenue. Right? And I think what it's also about is it's setting that kind of psychological bar. We're going to do what we say, and that's going to put people on their back foot. Maybe that causes some people into unforced errors, and that's really what I think it's all about. It's not so much about revenue generation.
So if we're continuously in that cycle,
yeah.
How much can that affect the stock market,
yes.
just in itself, even if the tariffs don't come to play?
So here's a thing that's popped up over the last couple of days, last couple of weeks. What I've heard is, hey, sentiment is turning very, very poor. It's fading. What I'm also hearing is more and more talk about stagflation. I don't know, and I've talked to a lot of people about, well, does the sentiment really affect activity? We don't know, right? If this continues, the answer is eventually, yes, it does, but right here, right now, unclear at this point in time. So that's why we continue to point out you have to have some risk aversion in the portfolio. You have to have some exposure to low volatility, because that's the only way I know to handicap the uncertainty.
Is exposure to low volatility code for holding a lot of cash?
No, not necessarily. It's code for looking at stocks at the lower end of the risk spectrum. They don't have to be utilities. Like, for example, in financials, typically what you see are insurance companies are a little bit lower volatility, because those lower volatility stocks, what they do in sell-offs, they typically outperform. They anchor that portfolio. But they are also capable of participating to the upside. So it's a really unique dynamic. It's a really unique play. And it's one of the few ways that I think is going to help you navigate these difficult markets.
Chris, how are utilities behaving at the moment? You brought up that sector. What do you do with them now? How do they fit into a portfolio, given it was a big AI trade over the previous 12 months?
So, John, last year we came into the year overweight utilities. We downgraded utilities from overweight to neutral back in September. That's where we sit right now. We like the space, but what we're telling clients, if you want, on a sector basis, if you want something more defensive, it's, it's staples. Because, as you point out, the utility trade has got caught up with the AI trade, and it may not give you that defensive properties that you want.
It's not the bond proxy it used to be.
Exactly. And you have very, very different dynamics with some of the Genco companies and the distributors. We wanted something that when stress comes in the marketplace, it's going to work, and that's what you've seen with staples.
Is it funny there's so much stress around at the moment regarding this market, and yet we're not down by even 5% on the S&P?
Yeah, and what we tell people is, take a look at low volatility, take a look at value, take a look at Europe. Those are pretty strong markets. What's weak is growth is weak at this point in time. And getting back to Lisa's comment about momentum, people think, oh, tech is momentum. Well, if you look at the MTUM or the momentum ETF, tech is the most underweight sector of any sector represented in the momentum index. What's momentum now is financials and communications.
Chris, appreciate your insight as always. One of the best. Chris Harvey there of Wells Fargo on the equity market. Let's give you a quick update on stories elsewhere this morning with your Bloomberg Brief. There's Danny Berger. Hey, Danny.
Hey, John. Crypto recouped some of last week's losses over the weekend after President Donald Trump posted on Truth Social yesterday about his plan for a strategic reserve that includes more tokens. Many of the details of the president's plan are unknown, including how much the government will actually buy and how the purchases would be funded. Kroger chairman and CEO Rodney McMullen has resigned from the company. The news follows a broad investigation into his personal conduct. The company issued a statement confirming the conduct in question did not relate to operations or financial performance and did not involve Kroger associates. The board appointed lead director Ron Sargent to serve as interim CEO. And in sport, Fulham are headed to the FA Cup quarterfinals after beating defending champs Manchester United on penalty kicks. Fulham took a 1-0 lead into the half before Bruno Fernandes tied things up in the 71st minute at Old Trafford. Fulham's keeper saved 2 penalties to win the shootout 4-3. They'll be facing Crystal Palace in the next round. And that's your brief. John.
Danny, thank you. I tortured myself watching that game yesterday. I have no idea why.
I was about to say.
Absolutely dreadful.
I thought you were off that. I thought you were trying to kick the habit.
Such low-quality football. They look like a team that's about to get relegated.
I thought you didn't want to deal with the emotional turmoil.
Well, I didn't have any emotion in this game. I don't support either side.
Yeah, but you still are just angered by the absolute dreadful playing of football.
Just awful football from Man United. Clearly someone in the control room does not like Man United, and that's why that story got in there. Up next on the programme, preparing for tariffs.
I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also.
That was the Treasury Secretary, Scott Bessent, negotiating in public. Mike McCormick of TD joins us next from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Big rally over in Europe, all-time highs over in Paris, France. Stateside equity futures a bump higher, up by 0.5% on the S&P 500. There's the move in foreign exchange. The dollar weaker, euro stronger. Euro dollar up by 1%, approaching 105 at 104.74. Under surveillance this morning, preparing for tariffs.
I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also. So in a way, we could have fortress North America from the flood of Chinese imports that's coming out of the most unbalanced economy in the history of modern times.
So here's the latest this morning. Global currencies under pressure as the Trump administration prepares to impose new tariffs on Canada, Mexico and China. Mark McCormick of TD writing, our positioning and short-term valuation tools tell us the dollar is oversold and cheap, a setup we haven't seen since before the election. Mark joins us now for more. Mark, welcome, buddy. It's good to see you. Let's pick up on that line. The dollar's oversold and cheap. Against what?
Gets everything. I'd say the thing that's probably standing out the most is EM currencies. It probably goes back to your last segment when people are talking about low volatility. You know, the FX market's version of low volatility is a carry trade. So EM currencies have come back, but as well, G10 currencies, particularly you're talking about the euro here, all these things look overbought. I think one of the things that's very interesting is we get kind of fixated again on a theme or a news story, or we're talking about geopolitical tensions, or we're talking about tariffs. We forgot about market fundamentals a little bit. And if we go back to, you know, kind of the positioning and some of the valuation drivers, what's happening behind the scenes is the market is extremely short the dollar now. Like, we have given up on the premium that's come through the dollar. We're forgetting that inflation, growth, relative fundamentals, at least where we're at right now, are still much better for the U.S.
So, Mark, does this mean that you're leaning into the dollar and you think that the dollar could reclaim all of the gains that it's lost since the inauguration?
I think there's a couple ways to think about it. There's kind of the short-term tactical setup, which we are very bullish the dollar on that. And then there's a longer-term forecasting period, which is next 6 months and next year, where we are actually bearish the dollar. Because we are in different regimes, we are in different environments, and the markets respond to different drivers through those timelines. So I think the piece of it here is that what you have to do is you have to connect the narrative to what everyone's talking about, to what's actually priced in and where markets are positioned. So again, we came into the start of the year when we had these conversations last year. Our view was that Goldilocks was an environment that wasn't going to play out. There wasn't enough volatility price in the markets. U.S. fundamentals were good, and the dollar was basically oversold. We have now swung to the other side of the pendulum here, where, again, the dollar was overbought for a little while. We came into the start of the year. Tariffs didn't deliver. There wasn't as much shock value, so the markets were disappointed. Now, again, we kind of swing back. So the dollar looks cheap. The markets don't seem to think about tariffs at all. It's very complacent. We have moved back into low volatility strategies. And another thing that's happening in FX is value is working. So all the lines you hear people use in the equity market is also working in the FX market, because the FX market is driven predominantly by equity trends. So I think a big piece of what's going on here is inflation, growth, the macro story, and now the technical setup still favor tactical dollar exposure, which is, again, the BDXY, the Bloomberg Dollar Index, to 1325, which is euro still around 102. Essentially, if we look at dollar China, we're still around 730. Weaker currencies across the board, driven primarily, again, through emerging markets, again, through higher stress.
I want to pick up on the euro, Mark, because you can overlay to all of these questions about the economy, fiscal questions as well, particularly when it comes to Europe trying to beef up some of its defense spending. Is your 102 valuation on euro dollar essentially a rejection that the European Union is going to come together with any kind of fiscal bazooka like what we heard being proposed by Reuters, by economists in Reuters over the weekend?
No, I think that's, again, it's a longer term story that people are kind of condensing into the immediate price action. So if you unpack all of that, you know, what is the thing that matters most to the euro in Europe in this context? It's energy prices. And so while we're kind of looking at whether or not this is a positive terms of trade shock, which reverses from what we saw in 2022, there's a lot of things that need to come into place. Like, energy prices actually need to come down to a level where, again, how is Europe going to how is it going to build production around this? The pipelines haven't been used for years. So there's a lot of degradation that's happened in the pipelines. They're not efficient at the moment. You can't just turn these things back on and then everything becomes cheaper again. So even you could see it in the futures market. You could see it in the energy markets. So this isn't something that's just going to happen overnight. So what the markets are building into are the expectations around an improvement in the European growth situation. But again, even if we get a $200 billion defense spending package, it's going to come through the rates market. But again, the immediate risk here is that tariffs come back. So basically what you can see is steeper curves in Europe. You can see the term premium. You can see a fiscal premium driving the back end of European curves. But you could also see the front end coming down because the ECB, the Bank of England, the European central banks are all dealing with negative growth shocks, which is what is more immediate than everything that's being priced in for the next 12 months, the next 24 months, which again reinforces our call that we will see a peak in the dollar. It's going to probably come this quarter, but tactically you should be buying the dollar to trade it to generate alpha, and you should be thinking about hedging risks of a weaker dollar over a next year or 2 years. And I think that's where the markets are completely dislocated on drivers that can be short-term versus drivers that are more longer-term.
Mark, I'd love to get your sense of what do you think this crypto reserve could actually mean for the U.S. dollar? Could it hurt it?
It could. It's an alternative source of currency. Again, I think part of it here is that there's probably a little bit more rhetoric and a little bit more entertainment value than any kind of real policy that comes in place from a crypto reserve. But again, anything that kind of reinforces alternative currencies to the dollar that the U.S. is basically building up assets around would mean a weaker dollar. So if this was done in principle and this was done in practice, again, this would be something that would weigh on the dollar because you're basically funding an alternative reserve currency that whether or not it would be the euro, the Chinese renminbi, or crypto, this is something that would be negative. But again, I think this is something in terms of the importance of what's driving FX, this is way down the tier spectrum. I'd say a tier 3, tier 4 driver that we don't even have clients that really even have asking questions about at the moment.
Mark McCormick of TD Security. Mark, thank you, sir. Euro dollar with a big move today, positive by 0.9%. A lot of that coming from the euro side. We're approaching 105 as the push for defense spending ramps up on the continent. Up next on the program, we'll catch up with Liz Young-Thomas of SoFi, Joe Feldman of Telsey Advisory Group, Steve Rasciuto of Missoula, and Robert Tipp of PGIM Fixed Income. From New York, the third hour of Bloomberg Surveillance. Up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. When I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it, and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
These high momentum stocks have started to pull back pretty significantly, and we think it's just an unwind of that crowded positioning.
I don't know that it would necessarily be a bad thing to see that broadening out in terms of performance.
Some taking of gains is to be expected after such a strong fourth quarter, all to be expected and could also be attributable to seasonals.
A key pillar of this bull market has been the resilience of corporate earnings.
If you can't see earnings broaden out, then it's a huge problem in the market today.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with a big rally over in Europe and some positive follow-through stateside. Equity futures on the S&P 500 higher by 0.5%. On the Nasdaq 100 up by 0.7. On the Russell up by 0.9. Your week ahead concludes with payrolls on Friday and an address from the Federal Reserve. Chairman Jay Powell, look out for that at the end of the week. At the beginning of the week, we're all staring down a barrel of 25% tariffs on imports from Mexico and Canada and an additional 10% on China.
This will be a clarifying moment. If they go on, you'll have to see a pretty big repricing in a couple of stocks, if not a broader market move. As we were speaking with Lori Calvasino of RBC Capital earlier this morning, and what she said, I just wonder how this feeds into what some people are talking about, which is essentially paralysis in the C-suite. How do you come up with bigger plans if you don't understand the ultimate goal or the ultimate number when it comes to tariffs? And that, I think, is going to be an ongoing theme.
It's hard to read the tea leaves around Canada and Mexico because Howard Lutnick said it's a fluid situation. There's been a flurry of diplomacy in Washington, D.C. between Canadian officials and Mexican officials trying to offer up enough concessions when it comes to what the U.S. and Donald Trump want to see. But then he said in this interview, there's going to be tariffs on Tuesday on Mexico and Canada. Exactly what they are, we're going to leave that for the president and his team to negotiate. But that sets the bar that tariffs will go in place, that there won't be another pause. And that's why it's a little bit confusing.
We know what the president wants to see in Europe, that's for sure. More defense spending. Check out European markets today. German bonds, lower. Bond yields, higher. Defense names, rallying really hard. Rheinmetall up by 13%. BAE Systems up by 14. All-time highs in Paris, France. On the equity market, the euro stronger. Where'd you begin, where'd you end?
Well, this begins with the idea that maybe there could be a real bazooka when it comes to fiscal and defense spending in Europe, unlike what Germany certainly has seen since the reunification with East Germany. Question of how feasible this is, question of how low the bar actually is, and question of just whether there is the collective will, let alone the financial power, to borrow at that kind of level.
Deutsche Bank saying this morning, potentially a fiscal regime shift of historic proportion. We've said repeatedly on this program, the President of the United States is forcing the Europeans to do some things that might actually be good for the Europeans.
And Friedrich Merz is saying the exact same thing. The U.S. is putting enormous pressure on Europe to act, which is why you have this report from Reuters about how much money they're looking at for a defense fund. Merz is saying they haven't discussed a date yet and for the convening parliament, but they will be discussing with their partners of what this means. And guess what? There's another European summit on Thursday. They love a summit. And potentially we're going to get details of how much they're willing to spend on defense just this week.
I mentioned this quote from the Polish Prime Minister over the weekend. Europe awakened, Europe understanding its global potential will be America's most desirable ally. That's exactly what the president wants to hear.
And this is the reason why, and frankly, let's just be honest, this goes back to Nixon. I mean, this has been something that U.S. presidents have been asking for a long time, contribute more to defense spending. Whether Europe does it or not, obviously, there are a lot of summits to be had. I do wonder, though, how much this is the goal and whether this is a cohesive goal to ultimately beef up Europe at a time where the U.S. wants to rejigger supply chains in a more dramatic way.
What did you say the other day? Because that's really the mentality of this administration. Europeans have nice trains and functioning infrastructure because an $800 billion U.S. defense budget.
Don't upset President Biden. Trains are great here stateside, aren't they? You love them.
Well, I'm sorry. I was in Austria and they lost a train. So they lost a train car.
Almost as good as the airplanes in America.
Pretty good. Equity futures on the S&P. Not going there. Equity futures on the S&P 500 up by 0.4%. Coming up on the programme, Liz Young-Thomas of SoFi on the momentum reversal, Joe Feldman of Telsey Advisory Group looking ahead to target earnings, and Steve Rasciuto on why he's constructive on the US economy. We begin this hour with stocks looking to rebound following last month's losses. Liz Young-Thomas of SoFi writing, there's been a notable shift in which stocks, sectors and assets are leading or lagging the broad market, and is one that can be best described as a reversal of momentum. Liz joins us now for more. Liz, I just wonder in your mind whether it's anything just more than that. We've had discussions about a growth scare, and based on the conversations we've had on this program, it feels like there's been a massive sentiment shift, and then you look at the equity market and it's down by not even 5%. How do we square that circle?
Well, I think there has been a sentiment shift in the sense that everything that got us here for the last 2 years has now gone a little bit out of favor. And you could have seen some of those markers in the second half of 2024 in terms that you look at just the AI-related stocks, the big tech stocks. There'd been more scrutiny over the spend and the expectations. So now coming into 2025, investors started to look for growth in other places, and then layer on top of that the fears about economic growth. So when we're looking at this rotation that's occurred under the surface in sectors, I think it's quite healthy. The difference is that you need a number of different sectors to keep up and to pick up the slack if technology stocks are not going to be the darlings again in 2025.
So Liz, let's pick up on the growth scare theme. Discretionary's had a difficult run of it, but you could say a lot of that is just Tesla. We have seen the bond market start to respond, though. 7 consecutive weeks of lower bond yields on a 10-year maturity. Are you seeing high yield credit confirm some of those growth jitters?
You do see high yield responding to that considerably. And that's been something that if you look at just high yield spreads over the last few months, you've seen this grind lower in spreads. High yield, as we know, is highly correlated with the equity market. But there has been a spike in high yield spreads over the last, let's call it 3 to 4 weeks, which I think, again, is healthy. There should be a correlation with the equity market. The big change that's occurred so far in 2025 is that yields started to respond, and I'm talking about 10-year Treasury yields, started to respond to growth fears more so than inflation fears. So what we were seeing in the latter half of 24 and even the early weeks of 25 were that the 10-year yield was rising because of inflation fears. Well, now the 10-year yield has come down quite a bit because of growth fears. The shift, though, is that that drop in the 10-year yield has not served as a tailwind for stocks. So you're seeing those growth fears bake through into stocks, into high yield spreads, and into the 10-year Treasury yield.
The reason why it is such a difficult market right now is because there's so many different themes that are layered on top of each other. We started the show talking about the potential for tariffs to come on Tuesday, a potential response from the European Union to different geopolitical developments, including the meeting on Friday with Volodymyr Zelensky and Donald Trump. Liz, from your perspective, what is more interesting to you this week and has the bigger catalyst effect potentially on the markets? What we get on Tuesday with respect to potential tariffs in the State of the Union, or the economic data that culminates with the non-farm payrolls report on Friday?
Well, of course, if the non-farm payrolls report is a surprise of some sort, that'll be likely the more market-moving event. The tariffs, if they do go into place as announced tomorrow, the market really already reacted to that back in January. Now, of course, there needs to be some repricing. There's been quite a bit of volatility since then and a lot of uncertainty. But if we do get a surprise on the payrolls report, I think that's a more market-moving event. The trouble is that we have to make it all the way through the week before we get there. So I don't expect a huge surprise on that payrolls report yet. I do think that as the first half of this year progresses, we're going to get some bumpier data in payrolls, largely because of some things that that are going on in Washington, and just weather patterns, other things that could be going on in the construction market, and the fact that mortgage rates have stayed so high, so the construction market has slowed down a bit. But I don't expect a huge surprise this week in payrolls.
Okay, so given all of this, are you actually leaning into some of the sell-off, or do you think that actually that this is a sign that things are going to be jittery for a while and people probably should reduce risk on some level because of that uncertainty?
I think you have to, first of all, define what you mean by reduce risk as an investor. So if you're looking at your portfolio and you are overweight, naturally, some of those Mag 7 stocks, technology, certain themes, maybe it's the AI theme, many investors have become overweight those themes just because the performance has been so strong for the last 2 years. So if you're looking at reducing risk by diversifying out the drivers that you're exposed to in the portfolio, yes, absolutely, I do think it's time to do that. And I think you can broaden out into some sectors that have the opportunity to produce growth, but are trading at lower multiples and aren't quite as exposed to some of this volatility that's occurring on a day-to-day or week-to-week basis. Those sectors, for me, would be healthcare first and foremost. I'd be looking at things like materials if we're worried about inflation heating up again. You can look at industrials. You can look at financials. Financials haven't traded great for the last few weeks, but that could be an opportunity. And then I still really like gold here. Despite the fact that it's hit new all-time high after new all-time high, there continues to be a lot of appetite in that market, both institutional and retail.
Massive run over the last year. Liz, appreciate your time, as always, and enjoyed the recent note as well. Liz Young-Thomas there of SoFi. In Liz's note, basically 2025 so far is 2024 upside down. Essentially, losers versus winners in 25, flip it the other way for 2024.
And really, she pinpointed the major change that has happened, which is that the decline in yields, the rally in treasuries, has not been the tailwind for equities that a lot of people believed that it would be, and it has come perhaps an increasing number of growth fears.
Equities doing better this morning. No signs of growth fears over in Europe. Massive spending plans apparently coming together. Bonds down and yields up, and equities rallying really hard. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Trump is expected to make an investment announcement, at 1:30 p.m. Eastern this afternoon. It comes ahead of tomorrow's tariff deadline on Canada and Mexico and a joint address to Congress later on in the evening. Let's get a check on shares of Intel. They are gaining 5.8% to the pre-market on the prospect of a manufacturing partnership with NVIDIA and Broadcom. Reuters reporting that the chip giants are running tests on Intel's so-called 18A advanced chip-making process. So far, the company's declined to comment. If an agreement is reached, it could generate hundreds of millions of dollars in contracts for Intel. Andrew Cuomo has announced that he is running for mayor of New York City. The former three-term governor of New York resigned in 2021 amid multiple allegations of sexual harassment. He enters a crowded race with challengers vying to unseat the incumbent Mayor Eric Adams. Cuomo's decision to run has upended the race, with several polls showing him leading the field. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls Plus, Joe Feldman of Telsey Advisory Group looking ahead to earnings from Target and the prospect of tariffs on Mexico, on Canada, on China. From New York, this is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equity futures on the S&P positive here by 0.4%. Stateside, a nice bounce. Over in Europe, a really big rally. We'll talk more about a little bit later. Let's get you some morning calls. First up, JP Morgan downgrading Southwest Airlines to underway, citing its surging valuation premium. That stock is down by 2%. Your second call from Morgan Stanley naming Tesla a top pick, highlighting opportunities in autonomy and robotics. That stock is up by 3% in early trading. And finally, Evercore adding Target to its tactical outperform list, saying it sees opportunity for the stock to, quote, play some catch-up. That stock is up by a little more than 0.8%. Let's stick with Target. Joe Feldman of Telsey Advisory Group keeping an outperform rating on the stock with a 150 price target, writing Target continues to elevate the customer experience and enhance its product offering through partnerships and popular brands. Joe joins us now for more. Joe, welcome to the program, sir. Can we start with tariffs first? I think we've got to. If we do get those tariffs on Mexico, on Canada, additional tariffs on China, who in retail, including Target, is most exposed?
Yeah, you're going to have a lot of exposure to just broadly to retail, and it's going to be a challenge for everybody. It's going to take prices up. That seems to be very clear. The retailers have told us they're going to negotiate with the suppliers and try to share some of the burden, but some of the burden is going to be shared by the consumer as well. It's interesting because the first go around with tariffs with China, the grocers or anybody with a heavy grocery contingent of their sales, like a Walmart or obviously Kroger, Albertsons, the true grocers, Target, even Costco, they really avoided a large part of this. But now with Mexico and Canada, that could be a big hit on the grocery side because of the produce that comes from is particularly from Mexico. And so there's going to be a lot of issues. I think that there's a lot of retailers. I mean, first go around, a lot of lumber comes from Canada. The home improvement guys sell a lot of lumber and building materials. There could be issues there. The home builders obviously would have some pressure as they're trying to build more homes. So I think there's going to be some issues for the consumer go forward if these tariffs go into effect.
Joe, from a retailer point of view, is it better to be bigger when facing off with some of these potential tariffs, given that you have a greater degree of power over your supply chain?
Yeah, I think that's a great statement. It's much better to be bigger. I mean, Walmart, when they hosted their earnings call 2 weeks ago or a week ago, they did not seem too worried about the tariff issue. They dealt with it before. They know how to deal with it again. They've diversified their supply chain the last time this happened. And as you said, they can use their buying power and their scale. And so, it sort of starts at Walmart. You can go down the list and really get a sense of where there's the ability to do that. Obviously, the big box guys, some of the ones that I cover, have a little more ability to spread it around. But there's still going to be some impact. We saw it last time, and we're likely to see it again this time.
I wonder if there's almost a perverse benefit to some of the largest retailers if some of the smaller retailers go out of business or can't handle a potential added cost, which we've already seen on the margins. Does that seem possible to you?
Yeah, I think in this environment, anything's possible. I think that, there's a hope that the regulatory environment will ease enough and that will help on the tax side of things with the burden, but there's still going to be some issues. I mean, it's tough for smaller retailers. Think about even just the investment in their businesses. Walmart's racing ahead, investing in technology and trying to improve efficiencies, leveraging technology, especially new technologies like computer vision, generative AI, whereas a much smaller company or a single brand company,
that's much smaller, can't really do that with the same efficiencies that Walmart can and the same scale. So it does make it harder for smaller players to compete. You have to have something very differentiated, a reason for being, and to get people to kind of keep coming back on a repeat basis.
For those smaller players, how important is it potentially to see this administration open the door to potentially carve-outs and exceptions?
I think there's a lot of hope that that could be the case. You know I cover some small hardline brands that actually already have that exception or had that exception with the prior round of tariffs on China back in the first Trump 1.0. And I think that there is some hope that that could be the case, and we'll have to see. And, you know, different regions, they're not really just going after retail, right? I mean, if you were to impose tariffs on Europe, there's luxury goods come from there, but not a lot of, you know, apparel and furnishings come from there. So I think it really depends on what the categories are, which is a good call out. But at the moment, it seems pretty broad-based. And, you know, without question, every economist that I've read seems to indicate that you're going to see some burden on the consumer.
How much front loading are we seeing? This was the story at the end of 2024. Do you still see these retailers front loading and bringing in products to avoid the blunt of those tariffs?
You know, we've seen it a little bit where inventories have been accelerated, but not as much as you would think. And I think when we speak to the retailers, they're telling us that they're operating as if there's no tariffs at the moment. They're ready for tariffs. They're preparing. They've, you know, kind of game planned it. They've thought about it. But the retailers that have reported earnings so far, you know, prior to today, have not really put that tariff into their guidance. And I think that that's the approach that they're taking, which is that until we know, you know, is President Trump using tariffs as a threat, or is he using it, you know, to negotiate, or is he really trying to raise some revenue? And I think it's a little of both. So we may see things change come Wednesday or Thursday.
Joe, we have seen certain companies, though, step on some inventory landmines, and I'm thinking of Target specifically. What are the lessons they've learned from the more recent experience and the experience from a couple of years back?
Yeah, you know, Target has faced this issue now a couple times, and I think, you know, they tried to get ahead of the port strikes back in the, you know, late summer, early fall of 2024, and, you know, ended up getting stuck with a lot of inventory, basically. And, you know, I think that a lot of others didn't take that approach. Target was trying to be proactive. They did it a couple of years ago, where I think coming out of the pandemic, there was a great enthusiasm about what retail sales were going to look like. So we'd like to think Target's kind of gotten that straight. They've been bringing down their inventory. We'll see tomorrow when they report earnings. We're hoping to see a better trend on the inventory side. Their in-stocks have been very good, which is a good thing because you can sell the product. But to your point, you know, we've not seen too many retailers get too heavy with inventory. Like Walmart, for example, was not that heavy. You know, Home Depot, Lowe's, they're pretty appropriately inventoried at the moment on a per store basis. So things look okay for a lot of the big box guys.
It wasn't just the import numbers that got our attention for the month of January. It was also the spending, Joe. I'm sure you looked at the same data. Consumer confidence has clearly shifted. It's softer. We've seen that across a couple of retail surveys now. And I just wonder, we've seen it in retail sales too, by the way. Where you're expecting that to show up across the retailers?
Yeah, well, you are hearing a lot of the retailers have talked about a soft start to February. You know, we saw kind of later as January progressed, sales seemed to have abated a little bit or eased a little bit. And I think February is off to a sluggish start for some of the retailers, especially the big box guys. Some of the smaller specialty retailers, like the apparel guys, they were able to maintain pretty solid first quarter guidance. But again, some of the big box guys, they gave a cautious outlook. You know, they talked about weather being a big impact. We've seen that being disruptive through parts of the country this whole first quarter so far. So we'll have to see how that plays out. You know, I think there's a lot of emphasis once again on the second half of the year that the sales trend should pick up. I think there's a lot of hope that we'll see a normalization in trends for a lot of categories as the year goes. But we're sitting here today, you know, we are off to a little bit of a sluggish start. And again, the sentiment numbers have been coming a little bit weaker, you know, in the past couple of days. So we are a little concerned. The jobs report on Friday will be a big sign of where things are headed.
Joe, a lot of people are pointing to Walmart's earnings as really touching off the sell-off that we've seen, particularly in big tech, but more broadly, this feeling that maybe it's growth concerns that are taking front stage. How much do you hear from other companies that is the case, that this is something that is more persistent, that has a more pernicious kind of feel to it, rather than just maybe companies looking to get more wiggle room and lower the bar that they can then beat later on in the year?
Yeah, what's really interesting about Walmart and some of the others like Home Depot and Lowe's last week, and their sales guidance was actually in line with what expectations were for the most part. That really wasn't the issue. It was on the earnings side. So maybe, they're not saying they're baking in some tariffs and other pressures, but maybe they are trying to. But it really is something where, as you said, they may have been lowering the bar a little bit. It seemed to us that Walmart was being conservative, Home Depot, Lowe's, that there could be a better second half that could help some of the earnings reports for these guys. But I do think that they've taken a very cautious approach with the earnings side of the P&L. Sales have been, relatively steady and in line with expectations.
Hey, Joe, good to hear from you. Joe Feldman there of Telsey Advisory Group, going into target numbers later on this week and responding to what we've heard on the retail front over the past few weeks for good reason. For good reason, right? They've got to lower the bar because you might have to lower the bar even more, particularly for home improvement companies. You start doing things with lumber, different picture for those guys very quickly.
And the idea that it's going to hit earnings suggests that they cannot pass it all along to the consumer. And we've seen that with respect to soft consumer confidence and consumer spending. So if they cannot pass that along, okay, it might not be as inflationary. It will be a hit to EPS, and it will be a hit potentially to their shares.
How many times have we heard wait and see over the past few weeks? Wait and see. Heard at the business level, heard at the consumer level. Coming into February, Joe just saying just then, a lot of weakness starting to creep into some retailers to kick off the month of February.
To me, there's a real question here of how long there can be this wait and see and an outperformance in financials at a time when that's hinging on the idea of M&A picking back up.
Let's see if that spills into March. Joining us next on the program, Steve Rasciuto of Mizuho, Robert Tipp of PGIM Fixed Income. Lots of economic data this week, including maybe the biggest data point of the week. And it's not payrolls. It's a decision to put tariffs on Mexico, Canada, and China. That decision, 24 hours away.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only weekly daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
60 minutes away from the cash open. Equity futures positive by 0.4% on the S&P 500. On the Nasdaq, up by 0.75%. With your morning movers, here's Manus Cranny. Hey, Manus.
Jonathan, very good morning to you. What would 900 billion euros on defense look like? This is a personification of it, Rheinmetall in Europe. This would be a boom time for defense spending in Europe. JP Morgan raised the price targets across the sector by about 25%. Roll it down, have a look at Capri. We understand Prada are close to doing a deal to buy Versace, 1.5 billion. Take your mind back. FTC blocked Tapestry from bidding for Capri, and the stock dropped by 45% on that day, up 7 1/8. I'll leave you with a look at Intel. It was all that hubris around a breakup discussion. Well, today we understand NVIDIA and Broadcom are potentially testing what's called 18A to become a significant customer for Intel. And up she goes, up 6%. Jonathan.
Manus Cranny, thank you, sir. It's amazing to see this European story come together. A diplomatic breakdown in the Oval Office on Friday between two leaders, the President of the United States and the President of Ukraine. An emergency meeting for the Europeans becomes a little bit more urgent over the weekend, and they push for defense spending. The story comes out from Reuters that you're going to see more than just defense spending from the German government when they get their act together. You'll see infrastructure spending as well. Numbers pushing 400, 500, 600, 700, 800, 900 billion euros. So we've got the German debt market trading softer, bond yields higher. You've got the euro stronger going into the ECB this Thursday. CPI a little bit sticky as well on the hot side for the Europeans going into that meeting. And you've got defense stocks. Manus just went through one of them. Defense stocks across the continent absolutely surging.
There's a timing issue here, and I think it's an important one, and Mark McCormick was talking about that of TD Securities. The short term, he doesn't think this could last because there's a lot that has to happen before this gets through. Longer term, it could be a positive story for all of these things, for both of the defense stocks as well as the euro. Short term, what has to happen for it to really be a long-lasting move?
Record highs in certain parts of the European equity market this morning, including in Paris, France. Here stateside, we're focused on this. Tariffs on Canada, Mexico, China, just one day away, with a slate of economic data capping off with Friday's payrolls report. Mike McKee, our economics and policy correspondent, joins us now from Washington. Michael, what a week coming up.
Absolutely. And at 10 o'clock this morning, Eastern time, we get the first indicator that people will be watching, and that's ISM crossed 50, the expansion level for the first time since 2022 last month. Look under the hood today. Is it not just an expansion, but are we seeing inventories rise because we saw that big trade deficit in the last month? What are new orders doing? Tomorrow, I sit down with John Williams, the New York Fed Bank president, to see his reaction to whatever tariff news we get between now and then. Could be detailed, could be still up in the air. On Wednesday, we get into the whole idea of what happens with labor markets with ADP. Thursday, jobless claims, of course, and Friday is the big one on payrolls. But Friday, payrolls even get superseded because the chairman of the Fed, Jay Powell, is speaking, and we'll get his take on everything that's happened so far, we hope.
Mike, you're also there at the NABE Policy Conference as well. Just share with us what you and others are focused on at the moment.
Well, there's a lot of talk over there, and you can see this chart here that shows that there aren't very many federal workers as part of the overall workforce, so cutting them isn't going to show up in the jobs report. But cutting workers at the statistical agencies could affect the jobs report and others. And a lot of people, a lot of the economists at the NABE meeting say that they have heard a number of folks at BLS and BEA and Census have taken the fork in the road buyout. They're afraid that more job cuts are coming there and budget cuts, and that some data series will be discontinued. And of course, Howard Lutnick yesterday talked about the idea of totally messing up GDP reporting. So there's a lot of concern about how we will know the economy is doing going forward.
Mike McKee, changing the equation for GDP one step at a time. Mike McKee, thank you, sir. Looking ahead to payrolls, 160 is the estimate in our survey. That can change. More estimates will come through. But at the moment, Lisa, the median is 160, the previous month 143.
What is a good payrolls report at a time where people are looking for some sort of deceleration, and that is the confirmation bias that people have? If you get anything below that, does that have a bigger shift on markets? What happens if you get it above it? How rapid is the sort of recalibration of just how much weakness people are pricing in?
That conversation has shifted so much in the past few weeks. Barclays were with us a little bit earlier. U.S. recession, improbable, no longer unthinkable. That's a change. Steve Rasciuto of Mizuho says the U.S. fundamentals are healthy. He writes the following: the underlying strength of the business cycle is evident in the harder data releases. They will dominate in the longer run. Steve joins us now for more. Steve, good morning.
Good morning.
Thank you, sir. A lot of people have become almost bearish. Give us the constructive take on the U.S. economy.
Well, I think there are a lot of people who've been wanting to call recession. Okay, when you think about it, since 2022, we're now on our 7th recession theme. Each one has not paired out, and I don't think this one will either. The concept that DOGE is going to create some kind of major lapse in employment growth on the government side of the equation that the private sector will not be able to absorb over time, I think is just incorrect. To the extent that people worried about the fact that we're reducing immigration and where all the workers are going to come from, well, now if you have a transfer from public sector to private sector employment, maybe it's actually a healthy thing that takes place in terms of the economy, at least in terms of the transition. The thing you do have to worry about is negatives usually come before positives. So yes, you're in this environment now where a lot of the soft data has turned negative, a lot of people have turned negative, and therefore everyone's willing to jump on the recession story again. As I said, this is the 7th recession story since 2022. Think about that, 7 in less than 3 years. And everyone's convinced each one is going to be there, and everyone wants shock and awe type headlines. We saw a major investor in the marketplace today screaming about a global debt crisis. We saw Warren Buffett over the weekend talking about tariffs as basically a moral equivalent to war. Everyone's going for big headlines. The reality is, look at where the equity market is. We've taken out the Trump bump. That's basically what we've done. Look at the bond market. We're still well up from where we were in September, even though we're well off from the 480 high. But 480 has been a very, very strong resistance level repeatedly. So I think what we're really looking at is consolidations within markets rather than really breaking out a new trend.
We'll let politicians define bad versus good. They're in the business of doing just that. Who's the angel, who's the devil? They can decide. We're interested in markets of better versus worse. Is growth going to be better in 25 versus 24? 3% GDP down to 2.5 or up to 3.5? What are you expecting?
Well, to be honest with you, I think if we're in that 2.5 to 3 area, you're the 5th year of above-trend economic growth. That's never happened before. And I don't, in the post-war period, and I don't think that's a bad performance. It's certainly a performance that's consistent with where bottom-up earnings expectations are for this year, which is around 12.5%. And then when you look at all the negative headlines about earnings, our earnings revision tracker is minus 12.6%, which means 12.6% more companies are downgrading earnings and upgrading them. 12.6 is basically correction phase. It's not contraction phase in a market. And I think these are the important fundamentals. The headlines are getting out of step with reality.
Okay, hold on a second, because it's a little bit of a straw man argument. I've got to be honest, because honestly, there have been a number of headlines that have said recession. But when we talk to investors, most of them do not say that recession is their base case. Most of them believe that this is a slowdown, but it is a market slowdown, and maybe it's catch up from some of the post-COVID period that was inflated by some of the spending by the government. How do we measure whether this is something that is underpriced as a risk in the economy, in markets, the idea that the slowdown is more significant than people thought, even if it's not recession, right? At what point is it not workable for you anymore?
Well, you got to get below trend GDP, and you've got to have an argument that you're going to sustain below trend GDP. And we're sitting in an environment right now where the Federal Reserve has cut interest rates 100 basis points. The forward structure of rates is again anticipating 50 basis points more rate cuts. We've taken 10-year note off the peak by 60 basis points. So all those factors are coming in against the balance sheets that are very, very healthy, liquidity that's still very ample in the system, excess savings globally that's being generated, going to be looking for the best alternative. So I think you have to get to a sustained period below trend GDP, and I don't see that in the cards.
So this is ultimately, it comes down to a Fed argument, this idea that if the Fed cuts right now in response to a weakening trend, that you think it could be the policy error that could rejigger some sort of inflation or some sort of maybe positive growth shock? Is that what you're saying?
If the Fed were to cut again in this environment, I think you'll quickly see bond yields retrace themselves back to the 480 level. I'm not so sure they break the 480 level, but I think they'll push back because people will realize fundamentally this economy, as you said, a lot of the investors you talk to, the same people the issuers I talk to and the investors I talk to, all of these people are telling me business is really good. Things aren't a problem, and yet you have this negative headlines continuously beating on people. And I think as a result of that, you're holding down the expectations. If the Federal Reserve were to come in and cut interest rates again, I think people will quickly rethink the story.
Do you think the negative headlines, though, are actually creating uncertainty? People are on the sidelines?
I think there are people who are sitting there saying, why do I get involved at this particular juncture? By the same, in the investor side of the base. On the issuer side of the base, look at what they're doing in terms of the number of issues coming to market. They're willing to sell at these levels. They're telling you these levels are attractive. These spreads are attractive longer term. So I think what you have in here, and again, the bond market investors have pulled us down from 480 to 425. So there's been a substantial move. So I think they've put a lot of money to work. I think we're just getting to the point now where so much negative news is, and negative economic news and positive bond news. Think about what's priced into the bond market right now. 7th recession call. Not only that, Bessin's going to come up with something sleight of hand to reduce $800 billion worth of borrowing this year. Doge is going to save us $1 trillion every year for the next 10 years. All of this is priced into the market, and we're at 420. Why aren't we at 2%?
So Torsten Slok puts it this way. We're on a modest stagflation shock to the economy, not a recession. Do you see any stagflationary fears? Mohamed El-Arian said the same thing to us this morning.
Stagflation requires that you believe inflation is accelerating in an environment where the unemployment rate is rising. I don't see the unemployment rate rising. 4.1% is still below the natural rate. I mean, where do we have to be? 3.4 before they turn around and say the labor market's tight? So the reality is the labor market's healthy. And inflation is at 3, not at 2. Is that the end of the world? No. Does it suggest bond yields are expensive? Yes. But it's not the end of the world in terms of average individuals out there in the country. 2% inflation versus 3% inflation, not going to bankrupt them in a world where hourly earnings growth is going up 4.1%. And that's the other thing to look at in terms of the payroll numbers that come out on Friday, is that hourly earnings number and the unemployment rate, besides the slowdown that we're probably going to see in employment. 150,000 payroll employment is very consistent with trend GDP. Question is, how much of that is a function of weather? How much of that was a function of forest fires? How much of that was a function of Doge? We don't know. The reality is when you look at the moving average of these things, they're all doing fairly healthy, especially when you look at on a year-over-year basis. They're still well within areas that support growth to the economy.
You acknowledge in the near term, though, we might see some weak prints based on what you said at the start of the conversation. The destination might be good. And I agree with you. You could increase the dynamism of the American economy by removing the government and allowing the private sector to step in. That all makes a lot of sense. In the near term, though, how much weakness would you expect to experience in the next couple of months? You might describe it as a head fake if we get here, because we'll still end up somewhere good. But I'm trying to understand what you expect in the next few months.
I mean, to be honest with you, if we got to 2% GDP, I'd be fine with it. What you saw in terms of the Atlanta Fed numbers, when you think about it, we had this massive trade deficit shock, right? Yep. It didn't show up in wholesale or retail inventories. And everyone sits here and says, well, it can't be in manufacturing inventories. Well, if you're manufacturing and you're pulling in a lot of intermediate product, we don't know the manufacturing inventories yet. We'll see them. Maybe the manufacturing inventories were very, very big. Maybe it's a big one-time shock in manufacturing. Maybe this data all gets revised. Maybe the consumer numbers get revised. The reality is you're jumping on every little marginal change when the reality is the fundamental trend has been healthy. We've called 7 recessions. since 2022, and we've had an economy that is growing above trend for 4 years, going to be 5 years. Think about it. There's a disconnect between the logic and the reality.
Steve, it's good to see you and catch up as always. Thank you, sir. Steve Ricciuto there of Mizuho. Joining us now is Robert Tipp of PGIM Fixed Income. Robert, I just want to build on what Steve just said moments ago. He's constructive on this U.S. economy. We keep calling recessions that never happen. Where are you with the team now?
Right. So I think we're constructive, and I agree with Stephen's constructive take by and large. I think you have to ask yourself, though, the question that he asked: why is the market having this big rally? And I think that, in a standstill situation, things are fine. That's a great take, but the tariffs are looming over the market. The policy framework, the policy backdrop is changing rapidly, and people are not sure exactly what to expect. And I think there was a perception that neutral is probably lower than where we are. So that, along with the fact that investors' equity allocations are pushed up by market appreciation, money fund balances are incredibly high, that creates a strong technical backdrop where, all else equal, people get nervous that they're not in the market, in the absence of accelerating growth, in the absence of tariff threats and things not, going by the wayside. People start to buy. So I think that's what we're seeing in terms of this big rally in the market. It's not really a realization on the economic side that there's weakness out there. It's fear.
It's fear, and it's a technical buying opportunity. Maybe we just had Steve Ricciuto on from Mizuho, and he was talking about his belief that this is a head fake, that if you look at the actual economy, it's doing pretty well. And if the Fed were to cut rates in response to this head fake, you would see 10-year Treasury yields retrace up to 480 once again. Do you agree with that?
I think that was a great point. I think that, if you think about it, that is what we have seen. The Fed did cut rates, interest rates did go up. And the Fed right now is not inclined to cut rates because the inflation picture is sticky. So I think what you have to ask yourself is, if they cut rates, all else equal, yeah, you would see rates go up. But the Fed's only going to cut if the economic picture weakens and or the inflation picture softens, and it gives them a reason to cut. Because right now they're standing, pretty firm. So I think, the things that we've seen in terms of developments of the last 72 hours are risk reducers, maybe not from the perspective of Ukraine itself, but from a global perspective, the U.S. and Russia resuming diplomatic, not necessarily relations at this point, but beginning to, sit at the table, I think is a risk reducer in the way that when NATO took itself out of the Ukraine crisis in 2022, that reduced systemic risk. So I think that is a positive. I think Europe working on defense and pulling together in that regard is also a balancing element. And it brings fiscal, and it could bring technology that comes along with the defense spending. So I think those are the positives. And against that backdrop, I think we're going to see a rebalancing. What we've seen is kind of a creeping wider of spreads over the last several weeks as the markets were really going past the saturation point with all of the policy changes and some weaker data. I think now you may see the rates picture stabilize or some inching higher of rates. Well, maybe spreads begin to get traction as the market wraps itself around this new set of news.
There's so much to unpack within that, Robert. I want to just go right to where you brought up, which is the idea of more military spending in Europe. And we see yields creeping higher over in the European region and then in sympathy in the U.S. When does that become something that could send yields globally somewhat significantly higher if there is a huge injection of fiscal spending in Europe?
Yeah, well, let's see how this goes. Bazooka is not the typical response in Europe, but they have shown an ability to react in recent years. So I think you will get something. It will have a marginal impact in terms of where government bonds trade relative to swaps. And we've already seen that where bonds have cheapened relative to swaps in Europe. And if Germany is the big spender, we'll see it there. If it's Europe-wide spending, we'll see widening of spreads there. But I don't think you're going to see it on a destabilizing level. But you will see it in terms of government spreads. In the U.S., I think there's an element of that has been positive. We have seen massive Treasury issuance. We've seen Treasuries widen relative to swaps. Those yields have pushed higher relative to swaps. I think that is an element of the positive credit backdrop that we've had in the U.S. and corporate spread tightening. So I think you're going to get a good balance. It's going to continue to be a pretty good range-bound fixed income investment environment, despite all these crosswinds or because of them.
Robert, I just want to jump in and just extend this a further 60 seconds. Help me understand if there's space for Germany to do the kind of things they want to do. I understand they have the fiscal space. This is a market question. Do we have the market space? And if we are buying highly rated German debt and there's a whole lot more of it, what are we selling?
Yeah, I think, this market is by and large underinvested when you look at the cash balances, the money fund balances. So I think the money is there, number one. And in terms of the first part of your question was?
Well, the question ultimately, Robert, is whether we have the space to do this. And I'm not talking about the fiscal space, I'm talking about the market space. Right. And if I'm buying bonds, am I selling something to finance that? Am I selling treasuries? Am I selling something else on the continent, something else denominated in euros?
Yeah, I think it depends on the central bank posture. If we were in a central bank rate hiking cycle and we were getting pro-cyclical fiscal stimulus, this would be a huge problem. But we're at 275 on the way down in terms of the ECB's deposit rate. They are accommodative. I don't think the market is going to have any major problems in terms of absorbing another 100 or 200 billion coming into the system, say, in the next few quarters.
Robert Tipp, appreciate it. Thank you, sir. Robert Tipp there, PGIM Fixed Income. Bramo, all things we need to think about in the coming months, potentially, coming quarters, coming years.
Yeah, especially if maybe the market can absorb 100 or 200 million in new bond issuance. What about $1 trillion in new bond issuance, which is some of the proposals out there?
Trying to figure that out. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some other German news for you. Sources there reporting that several people were injured, some critically, after a car drove into a pedestrian zone in the city of Mannheim. Sources say an SUV was driven at high speeds into a crowd of people. The driver has been arrested. The incident comes just after 2 people were killed in a car ramming attack in Munich. Firefighters battled over 170 blazes across North and South Carolina over the weekend. Strong winds and dry conditions fueled fast-moving wildfires, prompting evacuations and emergency declarations. Despite the fire's intensity, no injuries or structural losses have been reported. Disney-owned Hulu crashed during the Oscars last night, shutting out tens of thousands of customers during one of Hollywood's biggest events. As the awards show began, people were unable to log on to Hulu, which was broadcasting the event for the first time. The outage was resolved after about 2 hours. And that's your brief. John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for a busy week ahead. The week is absolutely packed. From New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal-making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, you can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never. Ready? Go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody.
The opening bout a little more than 35 minutes away. Equity futures positive by 0.4% on the S&P 500. On the Nasdaq 100 up by 0.7. Your week ahead might take a while to get through. This is what it looks like today. President Trump making an investment announcement at 1:30 Eastern Time. Tomorrow, Trump's tariffs going into effect on Mexico, Canada, an additional 10% on China. Plus, President Trump delivers his joint address to Congress on Wednesday. ADP, PMIs, plus the Fed's beige book. Thursday, jobless claims. Friday, a payrolls report and comments from Fed Chair Jay Powell. That's your week ahead.
Can't wait for the beige book. Just kidding. Look, we're all looking for what happens tomorrow. That's going to set the tone no matter what. And it's not just the tariffs. It's also State of the Union to really understand what the priorities are. After that, it is the economic data and how much there is a confirmation or a rejection of some of the weakness we've seen soon.
Technically, we wouldn't call this a State of the Union because it's still too early in the president's term. However, he's got so much done in the first few weeks that I think we can call this a State of the Union.
It pretty much is a State of the Union. Basically what he's saying, at least this morning, an hour ago in Truth, tomorrow night will be big. I will tell it like it is. I just want to know the tariffs. Does he come into that State of the Union joint address saying, I got great concessions from Mexico or Canada? Does he come in saying, I am going for reciprocal tariffs. I'm punishing those who let migrants in and fentanyl in, and the 25% went on.
We're going to find out in the next 24 hours. Coming up tomorrow to react, Julian Emmanuel of Evercore, Sucharita Kadali of Forrester Research, Stuart Kaiser of Citi, Michael Gapin of Morgan Stanley. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The rebound continues after an astounding bounce back on Friday. We're seeing futures gain 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a serious talk after a clash at the White House with Volodymyr Zelensky and President Trump. They may talk again, but only if they take matters seriously now.
And countdown to Tariff Tuesday. Trump levies on Canada and Mexico may kick in tomorrow, potentially affecting $1.5 trillion in annual imports.
And this week also brings Trump's address to Congress, the U.S. jobs report. We have a speech by Fed Chair Jerome Powell, retail earnings to look forward to as well. All of that and more coming up. But let's take a look at where these markets are trading with 30 minutes to go. Like Matt said, that bounce back continuing right now. We saw quite the bout of month-end window dressing to lift indexes higher on Friday, but we know that February in general was pretty ugly for equities. You take a look at the pre-market trade ahead of the first official trading day of March, a little bit higher on the S&P 500, a little bit more if you take a look at big tech in the NASDAQ 100, and then the bond market. This is actually the market to watch. I know that we're a stock show, but you take a look at the 10-year yield, higher by about 3 basis points right now, but the absolute level just astounding. We have some ISM data coming up at the top of 10, Matt Miller, and you think about all the growth fears percolating through this market, it'll be a big one.
Yeah, absolutely. Really paying attention to growth and inflation. I'm looking at European stocks for a change. That market still open, doesn't close until 11:30 New York time. These are defense stocks, and you can see the year-to-date surge. I mean, Hensoldt, for example, in purple, Rheinmetall there in blue have almost doubled as reports come out of Reuters that Germany is thinking about raising a 500 billion euro fund for infrastructure and defense, and Macron saying that the EU should chip in 200 billion for the defense of Ukraine. So the Europeans may be really getting things together in terms of funding, and they could be spending money here.
Devil in the details. Where does all the money come from? We'll talk a little about it, but good news for now. Looking at some stocks pre-market here. Coinbase Global up more than 9.6%. Of course, this is on the heels of the idea of a strategic Bitcoin reserve. You saw cryptos really surging over the course of the end of the weekend, and crypto-related stocks still up today, though some of the steam in the crypto markets overall less exuberant heading into Monday morning, up nonetheless. Capri up 8% pre-market on the heels of a deal. It says it's moving closer to selling its Versace brand to Prada. Also watching Intel up almost 6% pre-market. It is surging on a report that NVIDIA and Broadcom are testing chips on its manufacturing process.
All right, that is a fascinating piece of information there out of Reuters as well, certainly for Intel shareholders who've made that bet. I want to take a look at what's coming up this week because it is a big one. Katie mentioned that we will see ISM data at 10 o'clock this morning, but of course there are a number of even bigger issues for this market. I think the tariffs is probably the biggest one. Will they or won't they? Tomorrow is the question, and then tomorrow night we're going to see Trump give not a State of the Union speech, but a speech to the joint session of Congress nonetheless. And then we kick off, we wrap up, I should say, the week with a look at the labor market, so important to the Fed.
Absolutely. So we will see ISM data at 10 a.m. and we could see a big market reaction. You think about the 33 basis point decline in 10-year Treasury yields that we saw in February, really predicated on those growth concerns. We'll have a lot of temperature checks this week between, of course, ISM and also jobs on Friday. The address that we get from Donald Trump tomorrow, we know that he posted on Truth Social earlier this morning promising that tomorrow night will be big. I will tell it like it is, Shonali. That's a quote from the president.
Right, it's hard to know. You know, the last time we were going to see these Canada-Mexico tariffs there, of course, were delayed. Let's see if we get the full tariff, lesser of the tariffs. This all comes against a really fragile backdrop for markets, guys. I also want to point against that fragile backdrop. We have the Bloomberg Invest Conference starting tomorrow. We have huge names. We have Carlyle CEO kicking it off. We have Bridgewater CEO to talk about what's happening with all the geopolitical uncertainty. We have the Blackstone COO talking about the implications across public and private markets. And of course, we have us as we broadcast live from the set.
We'll be there both days. And we have a special extended show tomorrow. I think we'll be there 9 to 12. So looking forward to that.
Yeah, me too. Thank you so much. Anyways, after Friday's 10th Oval Office meeting, we're talking about geopolitical tensions. So we have to talk about Ukraine's Vladimir Zelensky saying that he's willing to meet Trump again, but only for a serious and constructive dialogue, as we've been talking about. Now, joining us now, Anne-Marie Horder, Bloomberg's chief political correspondent and co-host of Surveillance. Anne-Marie, given that you're just so close to the ground here, what was the fallout after that meeting on Friday that was so broadly publicized?
Well, I was at the White House on Friday. I wasn't in the Oval Office, but obviously I spoke to everyone that was in the Oval Office, following all the journalists and some officials as well. And I was there when they were preparing the lunch. I peeked into the room that they were supposed to dine in after they had that Oval Office meeting, and everyone was preparing for this to go through to sign that minerals pact. I will say, I spoke to a senior official over the weekend who said, at the moment, there is no deal on the table right now. Obviously, potentially, maybe if the rhetoric and some of the tone from Washington, Kyiv start to settle down, we could see that coming to fruition. But what I'm hearing from the U.S. side is that there was a lot of back and forth and heated exchanges in Kyiv, in Munich at the security conference, and then once again in the Oval Office. I think if you look at what happened in the Oval Office, there's two things I would point to. One, it was 40 minutes in, and Zelensky said, after Vice President J.D. Vance was following up with a reporter, said, can I ask you something? And that was the moment that you started to see really the bickering start, and basically this blow up just spiral downward. Greg Vallier puts it this way: regular readers know we're huge fans of Volodymyr Zelensky, a hero in a world that has very few, but he's human and often rises to the bait, as he did last Friday. So you can see this having frank exchanges, and I hear about them, between these two parties behind the scenes. What was so surreal about Friday was the fact that they were willing to do it in front of the press.
Yeah, absolutely. And also, I mean, it looked kind of like a setup. Obviously, a lot of us have seen the SNL cold open from Saturday night, in which they basically implied that it was Vance sort of leaning in and making that very butch statement in defense of President Trump, and asking Zelensky to thank the country once again. He often thanks the country and expresses gratitude to the U.S. You know, Alan Beatty in the FT writing that the U.S. has switched geopolitical sides and is now backing Russia against Western Europe on Ukraine. This is a sentiment that a lot of people out there, and I'm wondering how seriously it's being taken in Washington, Anne-Marie.
Well, the Trump administration will tell you that they're not backing Russia. They just want to be seen as more of an arbitrator of this so they can bring both sides to the table, which is why they don't want to go out talking disparagingly about Putin. Obviously, there's a ton of criticism and pushback for that because President Trump just a few weeks ago said that Zelensky was a dictator because Ukraine is under martial law and they haven't had elections since the war began. This is a ton of criticism, especially from Democrats, even a few Republicans like Senator Lisa Murkowski, who we heard over the weekend. The one thing I heard, and Norman Rule, former U.S. intelligence official, joined us on Surveillance this morning, was the same people that are criticizing the Trump administration for running a rapprochement, a reset, maybe a little bit more of an open dialogue with Russia, are the same people that had no problems having an open dialogue and doing a deal with the Iranians, which are responsible and the U.S. would consider a massive sponsor of state terrorism.
All right, Anne-Marie, thanks very much. Anne-Marie Horder in there talking to us about the tense meeting on Friday and what the repercussions may be is something we can talk about right now with Dan Skelly, Head of Market Research at Morgan Stanley Wealth Management. Dan, great to have you here on set with us. Thanks so much for joining us. We have seen a massive response in European markets. I was showing that chart at the top of Rheinmetall and BAE Systems, a bunch of European defense stocks that have, risen 50, 60, 70, 80% year to date. How much do you expect Europe to really get behind the defense of Ukraine and spend actual money at these businesses?
Sure, it's a good question. And look, they've been underspending, admittedly, for some time. So there's some catch-up to come here. And I think it's going to continue. And just stepping back for a minute, Matt, when you think about the U.S. market the last year, the last 2 years, it has climbed a classic wall of worry. We disproved a consensus recession view. We got the 95 benign Fed scenario. We got past the election with no contested result. And we got the promise and the potential of a red sweep. Now I would argue in the U.S. we're hitting a wall in terms of fiscal policy uncertainty and high valuation. And simply put, you're seeing a ton of rotation out of the last 2 years winners into some new winners in the U.S. and, to your point, internationally.
Yeah, and I mean, you think about the Magnificent Seven, it feels like not only are we rotating, but we're selling the past winners. And you talk about this wall that we're hitting, that we're approaching in the U.S. on different fronts. Let's talk about on the earnings front, because we're just past really the heart of this earnings season. And it feels like, okay, maybe the look back numbers were pretty good. The guide's pretty impressive, just at a broad level here. And I just wonder how you think about that corporate America engine going forward.
Well, Katie, it's a great point. And frankly, we exited around 17, 18% earnings growth in the fourth quarter, still expecting double-digit growth for the full year this year. But to your point, revisions have been lower. And the key point that we've been making for months now is the differential between Magnificent 7 year-over-year earnings and S&P 493 is compressing and is trading closer to parity after the Magnificent 7 was the only earnings game in town for 2+ years. And so what is that doing? It's quite efficiently leading to earnings stock leadership outside of tech, into financials, into other parts of the market.
So you talk about this compression that we're seeing, and maybe, the 495, not 493, are finally stepping up here. But you think about just the math at the index level, the fact that these big tech stocks are just so big, unless you have them stepping up to the plate and leading this market, it feels like even if you have this broadening out, it's not necessarily going to be enough to lift the index.
So that's an excellent point, and it's quite honestly in line with how we were thinking about this year all along. Interestingly, though, if you go back to January 27th, DeepSeek Monday, it was an 80% positive breadth day in the market, meaning NVIDIA was down 20%, powering AI infrastructure utilities in that cohort were down 20%, but it was an 80% positive breadth day. What does that mean? That means that the rest of the market is looking towards positive fundamentals in the economy, albeit we had a pull forward with tariff buying. We can talk about that. We're naturally slowing, but you wouldn't see financials and the payment companies, Visa and MasterCard, at all-time highs if we were approaching recession. So simply put, you're right. The math of the earnings picture, the tech leadership fading, suggests something more akin to a normal year, a 5, 6, 7% S&P year, which we frankly haven't seen in 24 months.
No one wants that.
Yeah, I know. It sounds pretty brutal after 20% or more for the last 2 years. But speaking of the index level, you make this great point in your notes that the S&P 500 failed 3 times in 2 months to break 6,100. BTIG makes the point that for most of this year, the S&P 500 had less than 60% of its components above their 200-day moving average. the breath sucks, to say the least.
Wow.
So how do you get past that? Are we looking at more of a drawdown before we see a tear higher?
So it's a phenomenal point, great highlights. And all I would say is the following. Right now, you have a unique dynamic where it's not just economic and policy overhang, it's technicals. And I think you make the right point in terms of just how aggressively retail buyers were post-election in a lot of that momentum cohort. And so you've seen the technicals break down dramatically. Adding on to the retail momentum has been systematic institutional selling. And so you're in the perfect storm right now, to your point. What we would say is this is all par for the course for 2025. It's a very different year in terms of what we've seen the last couple of years. Lastly, on the 10% drawdown, we wish we knew exactly when it may happen, right? We'd be on our own little private island forecasting from Zoom. But having said that, it's likely to happen this year, but it's unlikely that the 10% becomes a 20% bear market because no economic recession, no earnings recession, no Fed hikes.
So that means if we do see a 10% sell-off, you're in there buying. And have you raised dry powder for that? I mean, everyone seems pretty fully invested. So have you sold off your Mag 7 stocks, a portion of them, in order to take advantage of a 10% drawdown when it happens?
We have. Within our equity strategies that I manage, my team manages, we have started rotating as of spring of last year into financials, into healthcare, into industrials. And we made the Magnificent Seven much less of an overweight, more of a market weight.
But you've got cash ready.
We have some cash ready, but at an asset allocation level, we've been practicing more rotation into value, into some mid-cap ideas, and to your point, again, out of some of the large-cap growth ideas, just trying to position for what's happening now versus jumping for a life preserver altogether and raising cash. We haven't done that just yet.
Dan, 15 seconds. I know you can't predict, when exactly it will occur. The S&P 500 down 1.4% in February. Is it possible that 10% correction has started?
It could absolutely be possible because, like we talked about, we are uncertain if the tariffs are going to be universal or selective in negotiating tools. We're unsure of that. We have tax day coming up in April, and we've seen pretty poor seasonality ahead of that as well. I think the negative earnings revisions, frankly, could continue. And then I think a lot of people, like we talked about earlier, are going to misread this pre-buy in tariffs for a more genuine consumption slowdown, which could all be part of the cocktail of a 10% drawdown.
That wasn't 15 seconds, but it was super interesting. Great to get some time with you. Hope to see you again soon.
Thanks, Kate.
That is Dan Skelly of Morgan Stanley. Now coming up, the tariff countdown. China, Canada, and Mexico bracing for bigger U.S. duties. The latest next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure, to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get now to higher interest. Look at what's making headlines around the world. First off, a warning from Ray Dalio, the Bridgewater founder and former chief, says that the U.S. faces a major debt heart attack within 3 years if it doesn't commit to cutting the deficit to 3% of GDP, something he agrees with Treasury Secretary Scott Bessent on. Speaking on the Odd Lots podcast, Dalio warns the U.S. is facing the possibility of a lack of buyers for its debt, the servicing costs of which, by the way, are about 3% a year. Now, Ukraine President Zelensky said he's willing to meet with President Donald Trump again if he's invited. Zelensky said another White House encounter would have to be serious for him to make the trip. This follows Friday's explosive Oval Office meeting between the leaders of the U.S., Vice President J.D. Vance, and obviously President Trump, as well as Zelensky. Zelensky also said his country was ready to accept a natural resources deal with the U.S., something he's said before. And tariffs are set to begin tomorrow on China, Canada, and Mexico. Those North American levies risk driving up car prices for Americans by as much as $12,000. This according to a new study from Anderson Economic Group that sees the cost to building a crossover vehicle rising by $4,000, while the increase is triple that for electric vehicles. Tariffs are expected to affect some of the industry's most recognizable and best-selling models, including the Chevrolet Silverado pickup and Ford's Bronco Sport SUV. Katie?
All right, let's stay on that tariff story. One of the big stories of the morning. Joining us now is Brendan Murray. He heads up our global trade coverage over at Bloomberg News. And Brendan, we know that, of course, 10% tariffs were enacted on China. But you think back to the last episode with Canada and Mexico. We got that last-minute delay. As we count down to March 4th, is there any possibility that we'll see something similar this time around?
Yeah, I think there is, and it's it's being reflected in some of the things that we're hearing the administration say over the weekend. There was some talk of from Commerce Secretary Howard Lutnick that the president is seeing some flexibility in that 25% tariff that he's threatened on Canada and Mexico. So there seems to be, whether you're looking at financial markets or listening to the administration, it's fair to have some skepticism about whether we're going to be in an all-out trade war with across North America tomorrow morning. That said, there could be some sort of tariffs. Maybe they start off at a low level and say that's going to increase over time, or they target specific products to say that will just be the start of it if Canada and Mexico don't carry out the fentanyl crackdown and the border security issues that the U.S. wants them to do. So it feels like there's a deal to be had, but whether we can reach that by midnight tonight, we just don't know yet.
To that end, to Katie's point, when we saw the prior delay, there were a few things that you saw both Canada and Mexico put on the table. Are there specifics, Brendan, that we may know that the president in the U.S. would want to see? We know in broad strokes that he's looking at the fentanyl crisis, but what more does he want?
Yeah, well, I think he wants, and Scott Bessent said this in as much, he wants not just the border security issues to be addressed, but he's looking for more help in addressing the flood of Chinese imports that the U.S. is facing. Scott Bessent mentioned the phrase "Fortress North America," and he seemed to like that idea and said Canada is thinking about cracking down on Chinese imports. If Mexico and Canada could get together and do that along with us, then that sounds like a good approach. So it sounds like the makings of some sort of agreement or something that Trump could buy into, but we'll have to wait and see. There are only so many hours left in today, and from what we can tell, there isn't a whole lot of feverish talking going on yet, but there still could be this afternoon.
All right, Brendan, thanks very much. Brendan Murray is Bloomberg's trade czar, talking to us about these tariffs, which could come into effect tomorrow. Of course, we've seen tariff threats diminished previously already so far this year. Coming up, we're going to bring you fresh analysis on the rapidly developing geopolitical picture. Tina Fordham of Fordham Global joins us in the next hour to talk about Ukraine and tariffs with this White House. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
All right, welcome back to Open Interest. Minutes to go until the bells ring. You can see we're looking at a rally in the pre-market. The S&P 500 higher by about 0.4%. The NASDAQ 100 higher even still. And then the small caps also seeing a little bit of an outperformance here, at least relative to the S&P 500. We know we had a big day on Friday in terms of a rally, but a pretty bruising February overall. And we have some big question marks about growth, about the inflation outlook. We'll get maybe some startings of an answer when it comes to the data we have this week and also the tariff picture tomorrow. Now, coming up, we'll discuss the market moves with Maddie Dessner of Capital Group coming up next. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Continues after a bout of buying on Friday afternoon. We are now seeing futures rise ahead of this Monday morning open. This is Bloomberg Open Interest. I'm Matt Miller. You can see green arrows here under S&P futures, even bigger under NASDAQ 100 futures. So those tech stocks could drive trade, at least at the beginning of the day. Russell 2000 futures are up just marginally. Here at the New York Stock Exchange, you can see Citi ringing the bell after last week transferring $81 trillion to one lucky customer, only for about 90 minutes though. And then Euphoria ringing the bell at the NASDAQ marketplace. It's an awesome name, but the stock has lost 97% of its value in the past 4 years. In terms of the live trade, Katie Greifeld has a look at your averages. Katie, what do you see?
Well, welcome to your first trading day of March, and you can see we're starting on a positive note. The S&P 500 higher by about 0.3% if you round up. Big tech up about 0.5%. The small caps also seeing some love on this first trading day of March. Of course, we know we have a lot of risk events coming up just in the next hour even that could change this landscape. You think about ISM manufacturing coming up at 10, the jobs report on Friday, new tariffs coming tomorrow, and of course we'll hear from President Donald Trump and Jerome Powell somewhere in that mix. But at least for right now, there's green on the screen. Let's take a look under the hood as well. We're going to talk about crypto here. You have MicroStrategy, Coinbase, Robinhood, all surging after President Trump said that he's planning on including more cryptocurrencies than expected in a strategic reserve. There's some skepticism about that. Bitcoin itself is actually lower right now after a big rally yesterday. You can see that the actual U.S. listed equities, though, catching up to that weekend move now, led by the likes of MicroStrategy, up 14% right now, Shonali.
And Katie, I've got 2 words you might have forgotten. That is Merger Monday. I'm keeping an eye on Capri Holdings because Bloomberg learned that it's close to a $1.6 billion sale of its Italian luxury brand Versace to Prada. Capri up 8%. This is the stock, Matt, that was down almost 59% last year after its own deal with Tapestry fell through. Looks like it's doing deals on its own.
All right, finally, a report that NVIDIA and Broadcom are running manufacturing tests with Intel. Those reports are sending shares of Intel higher. This comes after Intel delayed plans for a semiconductor complex in Ohio until at least 2030. I know Central Ohio, the great state of Ohio, really was counting on that investment. So we hope it goes forward for the sake of those wonderful people.
Yeah, a lot of plans falling through in the world of AI. Isn't that the case?
Yeah, and Ohio definitely the story here. But I will note that this rise that we're seeing in Intel today, that builds on a pretty hefty year-to-date rally for the chip maker, up about 22.5% on a total return basis, a real reversal from what we saw in 2024. But let's broaden out this conversation at the market open and welcome in Maddie Desner. She is Capital Group Head of Asset Class Services. Great to have you join us again, Maddie. And I look at your notes, and about midway through February, you downgraded your estimates for equity returns by about 50 to 100 basis points. At the time, you called out high valuations. You had moderated expectations for earnings growth as well. Here we are 2 weeks later, and it seems like the rest of the market has caught up to some of those issues.
Well, thanks for highlighting the work. You know, from our perspective, capital market assumptions. This is what we've put out there for our expectations for returns, correlations, volatilities of asset classes over the next 20 years. So this is not a tactical estimate. This is more of a long-term estimate as an input to our portfolio construction process. And when we think about equities, we have to think about a couple of things. Number one, as you mentioned, earnings growth, an important element of this, but also the valuation multiples that we expect investors to pay for that earnings growth. And valuations have come a little bit ahead of what we see in terms of earnings growth expectations for the future. So that's really driving the decrease in expected returns, particularly within equities. That doesn't mean we actually don't expect healthy returns out of equities. We absolutely do. So we've taken them down by 50 basis points, but that doesn't mean that we don't think people should stay invested. In fact, that is one of the key outcomes of this work, is the importance of staying invested. Cash yields have become incredibly enticing for investors, but if you compare that to what you can get from a fully diversified portfolio over 20 years, you're talking about a 200 to 300 basis points difference, which can make a real difference in terms of retirement outcomes.
Maddie, what do you think you do in a market like this, where you're seeing a lot of parts of the market having turned into a sour mood? To Katie's point, February was a tough month for investors. The broadening trade brought by and large this year, the S&P equal weight versus the S&P 500, the NASDAQ, had outperformed. Are you successfully able to turn out of big tech into other sectors?
Well, it's important to think about diversification over the long term, Shonali. So, you know, one of the things that came out of this work, the capital market assumptions work, and some of our product development activities, is the focus on small cap. So this is a bit of a less loved asset class over the last most recent years. But if you look at the opportunity within small cap, it's actually quite interesting. First of all, to your point, you get diversified sector exposure, right? So less technology, a little bit more industrials, financials, consumer. So there's a differentiated exposure there. And we think there's lots of opportunity that will be unlocked within small cap over the next couple of years. There are about 29,000 portfolio companies held by private equity that we believe will be monetized over the next 2 to 3 years. That's going to be a tremendous influx of opportunity within the small cap space. So that's one area that, if you think about more broadly diversifying your portfolio across large cap, international, small cap, you do get some mitigation of the risk of that concentrated exposure that we're seeing specifically in U.S. large cap.
Are you concerned at all, Maddie, about the risks of inflation? I just highlighted a story by Anderson that the average car cost could rise between $4,000 and $12,000. They're already priced pretty highly. If these tariffs go into effect, does that change your strategy? Do you think this is just bluster, or are they going to happen?
Well, certainly all of those elements get infused into how we think about the long-term exposure within asset classes, and specifically with the geopolitical risk, inflation risk. One of the ways that we have reflected that is by looking at where we believe interest rates will settle over the long term. So we think about short-term rates, we think about where rates will settle in the long term, and what the path will be in between. Our expectation is that given some of the geopolitical risks, some of the challenges that we have with debt to GDP ratios, frankly, all around the world, that interest rates will likely settle a little bit higher than they have in the past. One of the reasons for that is because central banks are walking away from quantitative easing. And what that means is that you've got more price-sensitive buyers in the market, not the central banks, people who actually are buying long bonds for a whole bunch of other reasons. And they are going to need a higher clearing price and a higher clearing yield to compensate them for some of these geopolitical inflation sensitivity risks. So that's some of the ways in which we infuse some of these challenges into our analysis.
All right, Maddie, got to leave it there. Great to get some time with you to start off this week. That is Maddie Desner of the Capital Group. Some interesting commentary there to end on bonds, and I am so excited to hear from Jerome Powell himself on Friday. And you think about the information we'll have in our hands when we finally get there when it comes to tariffs, but also the economy. Specifically, he'll be speaking after we get that Friday jobs report, and there's a lot of focus on the employment picture right now.
Jobs are tough, right? You're coming off a 4% unemployment rate, and now looking at those DOGE cuts that are starting to hit the economy. Unclear. We were talking about it Friday as well, that you are starting to see more and more job cuts from big corporations. HP didn't really clarify to you where those job cuts would be.
No, we don't know if they're going to be in the U.S. or overseas, but I would say 4% is extremely low.
Historically
for
low,
unemployment.
but you know, we all care about the rate of change, the level of change versus the absolute level. But there's plenty of different ways to skin a cat,
It's
if you will.
also a fragile market that we are sitting in right now, too. Let's put it against that backdrop, because 4%, if we were to slip lower or see any bad data in there, you're hurting the hurt.
A fragile market at its highs, though, right?
Not able
We're
to
getting
break
back to
past
6,000 today, and the high was 61.44
A lot can
last.
change between now and 4 p.m. We've learned that lesson over and over again. But it's a good point. We're at relatively low levels of unemployment, relatively lofty levels when it comes to the stock market. And up next, we're going to talk about crypto as well, because Trump's latest plans for the crypto strategic reserve are sending stocks in the sector higher, even as Bitcoin itself falls. We'll bring you the details next. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, welcome back to Open Interest. Let's take a look at stocks right now because we're giving up some momentum when it comes to your major indexes right now. The S&P 500 still higher, but less so. The NASDAQ 100, similar story, still up about 0.2%, but we were looking at a gain of 0.5% just about 12 minutes ago. So really losing some steam here, as well as on the Russell 2000 with your small caps. Again, still higher, but less so. We'll continue to watch that one, but let's pivot now to our top calls. Some of the analyst action in focus this morning, and we start with Chipotle getting upgraded to a buy over at Morgan Stanley. The analyst says that the stock's weakness is an opportunity to buy into an excellent tech play. I'm not sure that I thought of Chipotle as a tech play, but Morgan Stanley does. Next up, we have Southwest getting cut to a sell over at JP Morgan on valuation concerns. The analyst says that the airline's best days are behind it. And finally, we have Deere no longer a buy over at Baird. The firm cites weak commodity prices and trade uncertainty as reasons for the downgrade. You can see that Deere defiant right now, up about 0.2%, Matt Miller.
All right, we'll keep an eye on that. Could turn around, obviously, throughout the course of the day. Let's talk about crypto-related stocks surging after President Trump talked up, including lesser-known digital coins, as part of a strategic crypto reserve. Cryptocurrencies themselves are a little bit lower, but massive rally over the weekend. Bitcoin was up 10% in yesterday's trade alone. Joining us now for more is Bloomberg's Bailey Lipschultz. Bailey, you know, I don't know about those other smaller coins, right? I mean, who cares, honestly? Sorry.
Apparently the Trump administration.
People care. I mean, once you start ETFs being launched off of them, then people start to care.
But Bitcoin is what really matters, right? And it came back up over 90,000, and that's why I'm guessing we're seeing a rise in Coinbase at all this morning.
Well, the thing when you think about it, though, when you look at a Coinbase or other companies that kind of offer trading, Coinbase, Robinhood, even the semblance of kind of value in XRP, Solana, other tokens is actually bullish for those companies because they make money off of facilitating trades. So when you're looking at strategy or MicroStrategy, Michael Saylor's Bitcoin engine up 10%, that's strictly driven by Bitcoin's rally in particular. But when you look at some of these other companies that benefit from other parts of the crypto or digital asset ecosystem, those stocks are rallying partly on risk appetite, but also just because if people are going to be pulled into these 8 tokens, then that actually just drives more trading, which by the definition benefits Coinbase.
Right, and those other tokens, I am going to go there because you are having ETF filings, particularly when it comes to the likes of Solana in the background. How likely is it that you see a reserve with assets that are not Bitcoin, frankly?
Well, the big question, Sonali, is what actually funds this? Is it buying? Is it strictly kind of tokens that are taken from bad actors that the government, instead of turning around and selling, just kind of puts on a hard drive? That's the uncertainty. That's the thing that analysts are discussing this morning, is what does this actually look like? Is the government going to go out and pump money into these tokens? Because by definition, that would drive some value inherently.
Is it bad to say that I'm a little less excited about whether we see a reserve or not, and more excited about the more near-term things like a potential for model portfolios at BlackRock having Bitcoin in it?
I don't think it's bad, Sonali.
I don't think it's bad either. I think it's exciting because I'm also excited about that. We got some news on Friday. I was off, but I still wrote this story, so I'm glad to talk about it.
Bitcoin ETFs, right?
Yeah, specifically their own. IBIT is the ticker, and it's at $48 billion already, and the asset manager announced that it's going to add a 1 to 2% allocation to IBIT in its suite of model portfolios that allow for alternatives. Model portfolios are basically funds that you package together and then sell to advisors. Advisors have been asking BlackRock for this, according to my reporting, and now they'll finally get it. And I think it's fun that it's just a 1 to 2% allocation, because volatility is the name of the game when it comes to crypto, when it comes to Bitcoin. Anything else than that, and your portfolio's overall volatility is going to go markedly higher.
Well, that's the big thing, though, that has been part of the pitch when you talk to crypto bulls, maybe the people who aren't all in and saying you should put your 401k in Bitcoin, but it's having kind of a flavor of that risk where if you do get that volatility, that impacts your underlying portfolio. But in a way, if you're looking out 20, 30, 40 years from now, maybe having 1 to 2% exposure to Bitcoin, even if it goes down to zero, isn't going to impact your ability to kind of live or continue to drive gains.
All right, we'll continue to talk about this on Shonali's Crypto Show.
Thursday this week.
Thursday this week. So if you had that on your schedule for tomorrow, move that up because we'll be at Invest.
Well, also the White House Crypto Summit is Thursday also.
Also that. So maybe we'll hear more noise, more pump from Trump. Thanks very much to Bailey Lipschultz. Coming up, Prada is moving closer to a deal to buy Versace from global fashion group Capri. Shonali was talking about it earlier. We'll continue that story in the Wall Street Beat next. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to Open Interest. We're looking at a stock market that has erased its gains on the headline S&P 500 level. We're now unchanged. The NASDAQ 100 not too far behind, and you can see the Russell 2000 leading the surge into the red right now. Little moves, but still the direction of travel is important here, and we are going lower ahead of course, an important ISM manufacturing report coming up at 10 a.m. Shonali.
Yeah, that's just what I was thinking. Volatile heading into that data. But it's time now for the Wall Street Beat. There are some stocks that are up, and they have to do with M&A. It is M&A Monday. Prada moving closer to a deal to buy Versace from Capri. Allegro is drawing takeover interest from larger competitor on semiconductor. And Philip Morris is exploring a potential sale of its cigar business in the United States. All that zen, I think, of those young ones are having. Let's get all the details with Bloomberg's Crystal C. I want to start with Capri, because we've been watching this stock, and it has really diverged meaningfully from Tapestry since the deal fell through and regulators clamped down on it. How badly do they need this current deal to go through properly?
So when the deal fell through, I think the world knows that Capri and everything that Capri is owned is for sale. And so this shouldn't come as a surprise that there should be chunks of Capri coming out. which the deal that fell apart tell us that it's probably not possible to buy Capri as a whole. So now we're seeing a tie-up between two Italian houses, big Italian fashion forces joining force. This Prada Versace tie-up would be meaningful, and we're not talking about an Italian version of LVMH, but we're looking at something similar on a smaller scale.
What's the story with, I'm more interested in the semiconductor stuff, because Prada and Versace.
Luxury is so
Your priorities
fun
are
to
so
talk
wrong.
about.
I
Come
mean, they're
He's
just
too,
so
he's too
common.
upscale, you know.
I wonder about, not just on semiconductor, but obviously because of I think it was a Reuters report, I wonder about people testing production with Intel at NVIDIA and Broadcom.
So this is a very particular deal. It's it's in chips for automotives. There are a lot of there's also a lot of political headwind, tailwind here. Like if you look at the Trump narrative, is very much that they want to bring back oil and gas. So you could see like the chips that goes into these, self-driving or like electric vehicles could potentially take a hit. So there are some predictions that whatever it is, electric cars related, that could see a slowdown in demand. So this is to build scale, and any potential drop in sales would potentially be compensated by a tie-up of two automotive chip makers.
All right, so Shonali likes fashion, Matt likes chips. I like cigars, and this is another deal scoop that you helped break. This is that Philip Morris is set to weigh a sale of its cigar business, and for seeking over $1 billion. This is interesting on two fronts to me. First of all, the potential deal itself, but also it seems like this shift away from tobacco in general, and that's a shift that Philip Morris has made as well.
So they're shifting away from like anything that you light up.
Combustible tobacco.
Combustible tobacco is no longer in vogue, and even though you're just saying how it looks cool, the world doesn't like it anymore. The world doesn't like it.
Saying that off camera.
Well, it's kind of cool, The thing about, they own IQOS as well, so they're actually moving, they own...
IQOS is heated.
It's heated. Apparently the technology is different. That is like healthier for you.
But it doesn't burn it.
You don't burn it,
Yeah.
so that is a big difference. And they're trying to move away from anything that you burn, and cigar is one of them. And this is actually also an asset that they inherited in a Swedish Match acquisition that closed a couple of years ago. So they're going through a portfolio review. So are a lot of big conglomerates, any sort of consumer company, any sort of industrials company that have multiple segments. I do now have to look at them and say which one do I not need and which one will make more sense to help out valuation as without this asset.
Right. I too like cigars. Crystal.
Yeah.
The honey dip.
Every
that's
once in a
controversial.
while, not,
very controversial.
You like to smoke a cigar?
Every so
like once a year.
Doesn't it ruin you for the next day?
It's social. My hair smells like it.
On your birthday, why not?
I feel like I've eaten a bird cage.
Anyways, Crystal, thank you so much for joining us here on set. One thing that's interesting about Crystal's commentary here is that you've actually seen M&A on the year down. It's down about 12-13%, and because of it, all the pure play investment banks have actually lost the Trump bump, all the gains they saw off the heels of the election. So if we look at a chart here of where they've come, you've seen Goldman, Morgan Stanley still maintain the gains because of their trading desks, but a lot of laggard trading here for what was a lot of exuberance coming out of the election.
I think this is, a symptom of the broader story, that you think about the industries that had a lot of enthusiasm post-election. Obviously, banks were one of them, given we were expecting this friendlier regulatory environment, and maybe we'll still get it, but certainly it is not the topic of conversation. It seems like right now this market is pretty narrowly focused on tariffs.
Yeah, absolutely, and other geopolitical issues. But I wonder if you do see a pickup in M&A still throughout the rest of the year. Are we still betting on that?
Yeah, the Juniper deal was the one that a lot of people saw fall through and wonder, wait a minute, is the Trump administration going to be as easy as we thought?
And maybe we'll get tax cuts as well, which would certainly be market friendly. And you take a look at this market right now, we have erased our opening gains on the S&P 500, now down really across the board here, from big tech to small caps to the S&P 500. Now coming up, we're counting down to that ISM manufacturing data. We'll bring you the details next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Homes, property, and cars have been damaged or destroyed by wildfires racing across parched land in the Carolinas.
The largest fire, which remains uncontrolled, is burning in the Myrtle Beach area, where dozens have been evacuated. Karen Lawyer lives there.
Tell us to evacuate, I'll evacuate. Nothing's worth anything except your life. It really is, because we can replace other things. Other things are replaceable, and that's all that matters to me.
Areas being affected by the wildfires in North and South Carolina could be hit by severe storms, including tornadoes, Wednesday. Jim Crisula, CBS News.
There is stormy weather on the horizon for a wide swath of the country's midsection. Meteorologist Craig Allen.
Very intense weather, ranging from blizzard conditions to severe weather and possible tornadoes all across the center of the nation from Monday night into Tuesday, and then it moves over towards the eastern seaboard on Wednesday.
Protests scheduled outside the offices of the National Oceanic and Atmospheric Administration, where dismissals by the Trump administration are expected to continue. What do Americans think? Correspondent Ed O'Keefe is in Washington.
Despite rave reviews from the president,
Elon is doing a great job.
A new CBS News poll finds just over half of respondents say Elon Musk and the Department of Government Efficiency have too much say in deciding whether federal workers should be fired. Well, 48% either say they've got the right amount or not enough.
Sources tell CBS News Defense Secretary Pete Hegseth has directed U.S. Cyber Command to pause all planning against Russia, including offensive digital actions. Correspondent Nancy Cordes.
It's a change that notably comes amid Trump's efforts to negotiate an end to the Russia-Ukraine war. But when he was asked yesterday, the National Security Advisor said it has not been part of these discussions.
The duration of the pause and the reasoning behind it, unknown. The deaths of Gene Hackman and his wife Betsy Arakawa are still a mystery. Investigators believe the actor had been dead 9 days before the bodies were discovered last week. CBS's Tom Hansen is in Santa Fe.
The couple had no surveillance cameras in or around their home, so police are turning to text messages, call logs, and their personal calendar to piece a timeline together. They are also waiting, of course, on toxicology results, which could be weeks away.
Their dog's body was found inside a kennel in the home. Word this morning, the CEO of Kroger Grocery grocery store chain has resigned. The company says it follows a board investigation of Rodney McMullen's personal conduct. No details, but Kroger says it was unrelated to the business. Dow up 53 points. This is CBS News. SpaceX says it's go for another launch of its huge Starship rocket from South Texas tonight.
A modified version of Starship is expected to land NASA's Artemis program astronauts on the moon and take off again, but Starship has a long way to go. None of its 7 test flights have been 100% successful. It hasn't demonstrated the ability to take off, land, and take off again, nor has it shown the ability to launch and refuel in orbit in order to boost large payloads to the moon. This flight is expected to last about an hour and demonstrate Starship's ability to launch satellites into orbit. Peter King, CBS News.
Some local heroes honored at last night's Academy Awards.
Please welcome members of the fire service who bravely responded to and battled the Palisades and Eden wildfires.
Host Conan O'Brien made them read his jokes from the teleprompter, including LAFD Captain Eric Scott. Deborah Rodriguez, CBS News. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. We've got some economic data crossing the tape. We're going to break that down in just a moment. Josh Wingrove, Bloomberg senior reporter at the White House, talked to us about the tariff situation. Maureen Gilbert, CEO of Wealthwise Financial, is just going to join us to talk to us about the markets. But we want to get to this economic data. ISM manufacturing data came out. We're looking at 50.3. The consensus was 50.7, so a little bit weaker there. New orders, kind of interesting. Consensus was 54.6, came at 48.6, so a big miss there. Tim Fiore joins us, chairman of the Manufacturing Business Survey for the Institute for Supply Management. Tim, what do you make of this ISM data coming out here on our manufacturing buddies?
Well, hi, Paul. Hi, Alex. So, hey, I think the real story here, let's get right to it, is the prices number is 62.4. We're up 7.5 points. And, you know, in December and January, we had some price growth too, but we really were putting our prices in for the 2025 economic year, for the delivery year. So there's really no reason for this number to go up so high, except for the fact that as soon as tariffs were announced on aluminum and steel, the spot market immediately jumped up 20%. Now, our 62.4 number is a measurement really of how wide the lake is, not how deep it is. So what this is really saying is a lot of companies were impacted by the steel and aluminum increase that was almost immediate. And it had a carryover factor, I think, on what's happening at a new order level, because it's essentially frozen people from placing orders because suppliers and sellers are arguing amongst themselves about who's going to pay for this. Then on top of that, the inventory number grew, in part because of the Chinese Lunar New Year materials being delivered, but also because people were pulling forward material in anticipation of tariffs. And then your supplier delivery number went up too, in part because suppliers may be refusing to deliver until customers agree to pay the increased cost. So, overall, this is the 50.3 looks pretty good, but the guts of this doesn't look pretty good.
Yeah.
If you had a stable input number, this number would have been in the 48 range.
So, wow. Okay. Also, the employment number dipped significantly as well. I felt like the narrative before was that we weren't seeing layoffs, but we weren't seeing hiring. Has that now changed?
No, you're exactly right. We're continuing on the same cycle that we've been for the last 3 or 4 months. I think what's happening here is, in the absence of some confidence that we're going to start to grow here and not have a burp, this does not support another rate cut. I think what's happening is people are continuing to release people, but they're not doing it so much, Alex, this time on layoffs. It's more about attrition and freezes. So they're not overreacting here, but they are deciding that, well, let's continue to destaff here slightly, but we're not going to use a layoff activity. We're just going to freeze and we're going to attrit down a little bit until the environment becomes clearer.
All right, Tim, thanks so much for joining us. Really appreciate it. Tim Fiore, he's the chairman of the Manufacturing Business Survey at the Institute for Supply Management. Smart kids call it ISM. This may be, I guess, kind of one of the first concrete data points that we'll point back to is about the potential impact of some of these tariff discussions on actual manufacturing activities. So we'll keep that in mind. All right, right now, let's take a look at these markets. We'll go to Mr. John Tucker and get a Bloomberg Business Flash.
All right, happy Monday. This Bloomberg Business Flash is being brought to you by IBKR. Will the U.S. CPI exceed 2.4% in March 2025? Trade your prediction with IBKR Forecast Trader. The yes was recently at 60%. Buy yes or no. Earn $1 if you're right. Go to ibkr.com/forecast. Right now, the major indexes are all lower, but you look beneath the surface. Actually, 8 of the 11 major indices group in the S&P 500 are higher. Doing the damage right now, NVIDIA with its market weighting. In fact, it is the worst performing stock right now in the S&P 500. NVIDIA shares are down 5.1%. Now, overall, 333 stocks are higher in the index, 168 they are lower. And new tariffs set to take hold tomorrow. Lori Calvasina at RBC says the tariffs may actually finally push investors over the edge.
We haven't technically, in my mind at least, had sort of a true pullback. We've had a little bit of volatility in data. I think we've been overdue for a 5 to 10% drawdown. This could be the thing that takes us in there, but there are a lot of other moving parts as well.
We don't know what he did, but it's bad enough that he lost his job. The supermarket chain Kroger replacing Chief Executive Officer Rodney McMullen following an investigation into his personal conduct. Shares of Kroger right now down 1.2%. And Sonova Energy stock, that's behaving badly. Those shares, they were plunging. The company doesn't have enough cash coming in to meet its obligations, and it's also suspending guidance. Never a good thing. S&P 500 down 20 points. Dow Jones Industrial Average pretty much flat right now. The NASDAQ 100, 81 points lower. That is down 0.4%. Two-year yield up a basis point, 3.99.9. I think we can call that 4% right now. And the 10-year, 2 basis points lower, and that's at 4.18. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Missed you on Friday.
Yeah, I know, but you were awesome. I heard you crushed it as usual.
As
always. Amazing. Yeah. Alex Steele here alongside Paul
she
Sweeney and John
giggles.
Tucker. I have to point out that Sonova thing is actually quite a big deal because Sonova was supposed to be the one that had its act together. Like SunPower had difficulties, for example, but Sonova was supposed to be a little bit more stable with better fundamentals, positive gross margins, positive adjusted EBITDA, and even cash generation. So this is something to really take the industry.
I
These are my
should
2
say it's
cents.
down 60% at
It's something.
65 cents a share.
Yeah, and usually talking to John Berger, the CEO, he's usually really out there in terms of growth, in terms of demand, and it's a little dicey. Okay, to say the least. All right, a big part of all this, of course, is what's going on in the Trump administration. John Tucker was just talking about what happened to the S&P after we got that weak ISM manufacturing data. Josh Wingrove is joining us, Bloomberg senior White House reporter. He joins us now on the White House lawn. Hey, Josh, good to chat with you. We're clearly waiting for these tariffs to be put into effect tomorrow. My question, though, is how sensitive do you think the administration currently is to the market, which is saying something a little different than maybe we were expecting, say, 4 months ago?
Yeah, I think that is seen as the sort of one true guardrail that President Trump pays attention to. Now, that said, many of his aides have been saying, look, like when in the first term we did a lot of tariffs and things didn't really go sideways, although independent analysts will tell you there was a lot of sort of weakness periodically on the underbelly of the economy in the first term. The big question right now is this all a bluff? And remember, this is only one stream of tariffs, and if you've been having trouble keeping the plot, not that any of us have, obviously, but it would be understandable, because you've got these ones, you've got ones next week on steel and aluminum, which, by the way, would hit Canada and Mexico pretty hard, regardless of whether there's another delay tonight or not. And then, of course, in April, you have not only the sectoral tariffs on autos, maybe lumber, maybe chips, maybe pharmaceutical drugs, all of which could hit Canada and or Mexico pretty hard, and those other tariffs, those so-called reciprocal tariffs that would be on a country-by-country basis, including, of course, maybe Canada, Mexico, and China on top of whatever does or does not happen tonight. So things are coming down multiple paths, and there's going to be a lot of focus, of course, tonight on whether these go in or not. It's, a bit unusual that we're sitting here, we don't know. A month ago, we were in the same position of what happened. There were calls between President Trump and President Sheinbaum in Mexico, and Prime Minister Trudeau in Canada, who only has a few days left or so as Prime Minister. We don't know right now whether those calls are on tap. That would be one thing to look for today as a signal of whether there'll be another deferral. Remember, of course, the China tariffs also could be doubled from 10 to 20% today. No real sign of any indication that would be put off. So, these things could all move independently. It's maybe not all three or none.
Josh, we're going to hear from President Trump addressing the joint session of Congress tomorrow evening. Any preview there? What's kind of the agenda?
I mean, he wants to take a victory lap. He wants to talk about the things that they've done in the first month. I think we're going to talk about the border. That is context for the tariffs, and really it's kind of an eye of the beholder thing on how you choose to read that. He's been, tweeting or posting about border numbers coming way down. Of course, the border is the justification for some of these tariffs. So, he'll either be there to say, look, I just dropped tariffs on $1.5 trillion in goods, and, here we are, and we're into a trade fight now. Or he can declare victory on the border. Maybe that gives him a window to defer at least some of these tariffs. But other than that, I think we'll hear a lot about the border. We're going to hear a lot about, of course, America First messaging. The backdrop of that, of course, will be the fallout from last Friday and the ongoing question of what will happen in Ukraine. Will there be a minerals deal? These are all just swirling in the air. So, Trump is a showman at heart. So I think a lot of this will be pomp and show and circumstance. Of course, he wants to point to what he's done, but there are questions, huge questions, swirling about what comes next.
So what's the off-ramp for the tariffs this evening?
If Trump decides that Mexico and Canada in particular have done enough on the border, then he might defer them. Secretary Besant, of course, has talked about maybe reciprocal, that's maybe a bad word to choose because we're using another thing, matching tariffs on China that Mexico and Canada have either talked about or in some cases already done. So that's been a bit of a puzzler. He's sort of asking for stuff that's already out the door. And if they can get sort of this fortress North America type of idea into President Trump's sort of, get his buy-in on it, then maybe there's a deferral. We also don't know that these will move at the same time. Remember, a month ago, Mexico was deferred before Canada was. Trudeau and Trump had 2 calls. Trump has been very critical of Trudeau. So right now, we don't know if any one or all 3 will, again, move as one. I think this is a really important point. The way they've technically done it is by doing separate executive orders so they can pull and punt and, adjust on the fly. One other quick thing to flag is last night, they tweaked the Canada and Mexico ones. It is either a signal that they plan to proceed or at least a signal that they want to be seen as threatening to plan to proceed with these tariffs. And what it did is tweak some of the rules on de minimis change, which affects parcel shipping, basically punting that until they can figure out a way to collect tariffs from either individual retailers or mom and pop shipping things across the border. Mm-hmm. And so that is if they're fine tuning, that suggests that they're at least holding open the option to go ahead with these tariffs, if not planning to do so explicitly.
I mean, in the meantime, President Trump will be speaking later on today. He hinted that there will be some economic policy rolled out. The Wall Street Journal now reporting that the TSMC is expected to announce $100 billion investment in the U.S. For chip-making facilities. You have like 20 seconds. Is this the kind of thing we can expect now at 1 o'clock?
I mean, I will defer to my friends at the Journal if they're reporting that Trump has loved to make these announcements, big numbers. I will say until now, the numbers have not always withstood the full light of day when you dig into the details. So we'll be looking for those details today.
Well said, Josh. Appreciate that. Josh Wingrove, Bloomberg senior White House reporter, and Bloomberg, of course, will be bringing you that live later on this afternoon. The Journal reporting that TSMC expected to announce $100 billion in investment in the U.S. All right, coming up, Lorraine Gilbert is CEO of Wealthwise Financial. Join us for her outlook on the market as we head into that State of the Union tomorrow. Equities around the lows of the session after that weaker ISM manufacturing data. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we are being brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Of course, the tariffs are set to take effect tomorrow. It's hanging over the market sentiment right now. The VIX, which is Wall Street's fear gauge, That is elevated, and it's over 20 right now. The major stock indexes, they are mixed, a little change right now. NVIDIA, that's down 5%. And if you take its market weighting, you'll know why the major averages giving a lot of red right now. The worst performing stock in the S&P 500, NVIDIA shares right now down 4.25%. Las Vegas Sands, the best performing stock in the S&P 500, it was up over 6%. And you heard at the top of the hour Tim Fiore saying he was gloomy about the latest economic data. The ISM factory activity edging closer to stagnation in the month of February, and a gauge of prices paid for materials surging to 62.4 in the index. That is the highest since June of 2022. 2-year is up 1 basis point right now at 3.94%. 10-year is down a basis points. That is 4.19. Dow Jones Industrial Average up just 10 points. The S&P 500 down 7 points, and the Nasdaq 100 right now 13 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Alex and Paul.
Happy Monday.
Happy Monday.
Happy Monday. Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Also check us out on YouTube. We're moving off the lows of the session here. The S&P is now almost making a round trip to flat after that weaker than expected ISM manufacturing data. Lorraine Gilbert is CEO of Wealthwise Financial, and she joins us now for her outlook on the market. Sentiment is not good. Whether you look at retail, whether you in any way you slice it, it's not great. What do you do in that kind of environment?
You know, this is going to be a volatile year in the markets, most definitely more volatile than last year. So we're taking the stance that we're buying on those dips versus de-risking. We don't see that this is leading us into a recession. So given that we're still constructive on the markets, we're looking for opportunities as we have days where the markets are taking a dip.
How about semiconductors? That's a market that's down about, I'm looking at the SOX here on the Philadelphia Stock Exchange, semiconductor index down about almost 5% year to date. How do you think about semis?
Yeah, so we're very constructive on semiconductors. So even though we've had a pullback year to date, it's an area of continued growth. AI is still the story that's going to create continued momentum. And with that, when you look at semiconductors, the spend last year was $426 billion of those companies that were in the S&P 500, the 17 semiconductors in the S&P 500. And so what we see on those sales, that's going to continue. In 2027, it's expected to be $700 billion. So that equates to an 18% year over year sales growth number. If we look at profitability, that's even higher, 28% year over year earnings per share growth that we see. So once again, when we see dips, those are opportunities because we see that as a long-term play.
So what other areas do you like buying on the dips, and what's an area you don't want to buy on a dip?
So we're most constructive still on large cap because of, continued strength in balance sheet, cash flow. That's where a lot of growth we see happening. We do think there will be a broadening out of the market, but it may not be as soon as we would like. So we're sticking with the large caps and the mid caps. So going down in capitalization to mid caps, being cautious on small caps, just with rates still being higher for longer. We think it's going to take a while for those rates to come down. That's going to be tougher on small cap companies that rely on a lot of financing. So keeping it more in the large and mid cap, looking for opportunities in the small cap where there's a lot of profitability for certain companies, but it's definitely a stock pickers market in that area, not more of an index market in that small cap area. So we would be cautious on the small caps.
Lorraine, what are you guys forecasting that the Federal Reserve will, in fact, do in 2025? Because I think the market's kind of uncertain here.
Yeah. Well, of course, we started out at the end of last year seeing many more rate cuts than we see now. So right now, we're expecting 2 rate cuts. That's really what the market is also expecting right now. So we're in line with that. What we do see is, as we've seen consumer spending starting to slow down and some surprise there in January with consumer spending, real spending, then it may be sooner. It may be more like June versus July. So we are thinking it could be June for that first rate cut, which will help consumers a little bit. The Fed is going to watch that carefully, watch consumer spending. They're obviously watching tariff talk and what's actually going to happen to determine when and how many more cuts they can do. But we're very constructive on 2026 with more rate cuts in 2026. So maybe slower in 2025, picking up in 2026.
And is that because growth has slowed, we need the cuts, or is that because inflation finally starts to materially come down?
Yeah, all of that. So inflation has started, in a sense, to slow. We're seeing those numbers come in better than they were, but it's still a concern, especially when you factor in how much will tariffs account for inflation. We think tariffs are a tool that it's not going to impact inflation that much. However, GDP is slowing. And so when you look at the facts of federal workers that are being laid off, unemployment that will go up, while we feel like that's all manageable, we're at 4% unemployment, average is 5.7. We have a lot of room there. There will be an effect. On the flip side, we also have CapEx spending that's positive. We have AI that's positive. So there are, these competing things, but I will say none of this leads us to think, even with the headwinds that we see, we don't see a recession. We also see with tax cuts that are going to be extended, that's also going to help the consumer.
Laureen, what do you make of this earnings season we've just been gone through here? We've had most of the companies report. What did that do to your view of the kind of where we are in terms of earnings?
It's been a fantastic earnings season. So really what we have to look at is how much is already priced into these stocks. You hear NVIDIA is a great example, right? They had an okay earnings call, but the fact is how much has already been priced into the stock. So we're looking for those opportunities as we see this pullback happening in stocks that may have been ahead of their skis, looking for the opportunities where we can buy into those stocks and still have appreciation over time.
All right, Laureen, thanks a lot. We really appreciate it. Laureen Gilbert, CEO of WealthWise Financial, joining us on the market and kind of where to buy those dips, particularly in the semiconductor index. All right, the other stock on the move is Kroger. That stock down over 1%. Apparently, the CEO resigns over, quote, personal conduct after a board probe. Want to get more on this with Jaewon Kong, Bloomberg retail reporter, joining us. Do we know, Jaewon, what this personal conduct was?
We do not. It's pretty limited, what we know right now. We know that the CEO resigned after the board conducted an investigation into his personal conduct. We know that it was a personal conduct and that the behavior did not involve the company's operations, but that it was inconsistent with their policy on business ethics. So now, Rodney McMullen, he's resigned effective immediately, and Ron Sargent, who's been on the board of the company for almost 20 years, he'll serve as interim CEO.
So how important is this CEO that did resign, Mr. McMullen? How important has he been to this story?
He's been in his role for, over a decade, and he's, led the company through really important moments, whether it's, really getting into the e-commerce business, led the company through the pandemic, the period of historic inflation that we've lived through. And most recently, he tried to merge with Albertsons in what could have been the biggest grocery deal in the U.S. in history. Of course, that did not come through after the government blocked it. But he's someone that's been at the helm for quite a while after a long tenure at the company, and is someone that's led the company through a lot of important moments.
How's Kroger doing otherwise? If we just take that away for a second, what's it like to be in Kroger business right now?
Yeah, so it's, the company did really well during the pandemic, and inflation, like a lot of its other peers in the retail business, that growth has started to moderate, partly as people look to save money. And, as we talked about, the Albertsons deal that had been sort of an overhang on the company for the last few years as they tried to merge, and then that deal got blocked by the FTC. They had to go to court to defend it. And we know the result now, which is that it didn't, go through, but that's been, a bit of a distraction for quite a while. And on top of that, the management team is also pretty new. The CFO left last year and joined a competitor, Costco, the chief merchant, which is, of course, a really important role in the retail business. He also left at the end of last year for a different opportunity. And so we're, kind of seeing both of those factors starting to play out now as they, try to operate and navigate through a lot of macro uncertainties.
So is there another M&A trade in there for in that supermarket business? Again, you mentioned Kroger's had some success and they've had some deals blocked. Are they still in the market for growth via acquisition?
It's hard to say right now. I mean, the Albertsons deal just fell apart, a few months ago. The expectation, I think, from people who follow the company is that, Kroger could look to do other deals down the line. But I think for now, the main priority is getting back to business and pursuing, organic growth.
Thank you so much. Didn't turn on my mic there. My bad. Man, it's Monday. Jae-Won, thanks a lot. Great reporting. We appreciate Jae-Won Kang joining us, a Bloomberg retail reporter. So this was a fun thing for me. So I come in and I get an email from Paul Sweeney, and he's like super into a BP story.
Yes.
He's like, we need to talk about this. And I'm like, yeah, we do.
Geek alert.
Geek alert. Oh,
exactly.
Yeah. So we'll be talking about that next. BP has a crisis. This is what we're writing here at Bloomberg, marking the tombstone for big oil's green pivot. We break down kind of where they went wrong and what the issues are and how it compares to its peers in Europe as well as here in the U.S.
European energy companies are much more forward-thinking in terms of going green versus the U.S. Is that fair?
They pivoted much more quickly and with their wallets when it came to alternative forms of energy.
Yep.
It didn't go so well for a lot of them, except for Total.
As Billy Bob Thornton's character in Landman says, it is not clean energy, it is alternative energy.
Right.
It's not clean. There's nothing clean about it, but I don't know.
Oh, okay.
That's what he's. I'm just quoting the story.
Maybe we can talk about that
Yes.
with Will Mathis, Bloomberg Energy reporter, coming up next. And this is all on the beginning of next week's huge energy conference down in Houston, where I will be there.
Oh,
we'll have a
you're
lot of
going.
stuff for you
Nice.
live. This is deep tease, guys.
John, you're not going.
Get
Sorry.
excited. You can come. There's a rodeo. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages all lower right now ahead of tariffs that are set to take effect tomorrow. We'll see if that happens. Wall Street's volatility index elevated above 20. NVIDIA, the worst performing stock in the S&P 500. Shares of NVIDIA right now down close to 5%. Then we have the data today showing U.S. manufacturing activity approach stagnation. And at the same time, the prices jumped. Katrina Dudley at Franklin Templeton says, you know what, investors can't get much more cautious than this.
If you look at the fear and greed index, we're right in that red zone that kind of flashes and says caution, caution, caution. So that's the first data point. The second thing is if you look at expectations, so consumer expectations for inflation, everyone is actually expecting a lot more inflation.
Only 15 more companies in the S&P 500 set to report earnings for the season. Of those that have reported, 74% reported positive earnings surprises. Right now, the S&P 500 down 3 points. The NASDAQ 100 is unchanged, actually just turning green, up by about 4 points. We're back and forth on some of these indexes. The Dow Jones Industrial Average up 30 points. Well, sounds like a threat. Elon Musk took to the Federal Reserve in a post on X Sunday, calling the central bank absurdly overstaffed. I don't think a lot of people know this, but the Federal Reserve, the U.S. Central Bank, is self-funded. They don't rely on the congressional
Actually did not know that.
process.
But you might make
You
that.
learned something from me.
I learned something from you every
Wow.
day. Do not undersell yourself, like that little screwdriver
Wow.
thing that you had that time.
That's
What
your
was it
big
called again?
takeaway. I don't even know what you're talking about.
It was what he wanted for Christmas and didn't get it. It's very sad. All
I
right,
wanted
thanks,
a
JT.
hammer.
What was it?
A hammer.
Yeah, but it was a very specific hammer.
It was a 22-ounce framing hammer. Didn't
There
get
we
it.
go. Not to get too specific.
Still haven't got it. My birthday's coming up.
Okay. Message received. So is mine. Alex Steele here alongside John Tucker and Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We also tap our deep bench of amazing reporters also all around the world to talk about the hot stories of the day. So next week is a week called Sarah Week. It's when every single energy, power, you name it, executive flies down to Houston, overtakes massive amounts of hotels, and everyone talks about energy policy and strategy. One company that's going to be in particular focus is BP. A year ago, the CEO of BP, Bernard Looney, took the stage and talked about how BP was trying to be an integrated energy company, not an international oil company. And this year, he is no longer at the helm, and BP is trying to ramp up oil spend in a really tough environment and move away more from its alternative energy. Let's unpack this with Will Mathis, Bloomberg Energy reporter. So, Will, what's going to be the pitch right now for BP?
Yeah, the pitch is that BP is going back to basics. You know, it was the most aggressive of the oil majors with their transition plans, big move into renewable power, especially, and now they've axed that target and are ramping up spending on oil and gas in the coming years and, you know, cutting spending on the low carbon stuff. So they're going to say, you know, this is a business we know, we're getting back to it, trust us, buy our shares.
So, Will, where is the energy industry these days on the green initiatives and the various, goals that are out there and the thresholds that are out there? Are people walking those back?
Yeah, I mean, for the most part, they are across the energy industry, and that's driven by investors who just want to get returns right now versus when there was, money was free, rates were super low. There was a lot of incentive to invest in big projects that would have long-term returns versus handing money back now with dividends and buybacks. And now investors are just kind of saying, we don't care about that as much. We just want to see the returns. And the executives of these companies are heeding that. And investors have also been rewarding the Americans who didn't make a shift as much as the Europeans did.
How much of this is political, Will, versus the economic argument you just laid out?
It's hard to say, but I think it's mostly the economic argument. I think if the green investments were yielding big returns, that the politics wouldn't matter as much. But the reality is that renewables is a lower margin business, and we spoke to a former executive at Shell for a story we published today, who was saying investors were basically saying, we want you to go green, but keep the returns from oil and gas, and that just hasn't proved possible. And investors have voted with their feet, buying shares of Exxon and Chevron and selling BP and Shell while they were doing their decarbonization plans.
It's easy to paint a broad stroke brush with like US versus European majors, but Total has seemed to thread the line. What did they do differently than, say, a Shell or BP?
Yeah, the big thing was that, Shell and to a bigger extent BP made specific commitments to cut oil and gas production. BP originally said back in 2020 that they were going to cut by 40% their oil production. Total never did that. They said, we're going to invest in new businesses, we're going to invest in power production, but we're also going to grow our oil and gas business. It's not going to be one at the expense of the other. And that's seemed to work in a way that, BP's and Shell's cuts to oil and gas haven't pleased investors as much.
Will, are we going to see more announcements of, hey, this big major oil company is going into this ocean or that ocean or this crazy part of the world to search for oil?
I think, they're going to go wherever the oil is cheapest. You see, Exxon is the best example. They are looking for barrels in the Permian, in Guyana, where oil is the cheapest to extract, so that even if one day peak oil does come, that they'll be the most competitive in a shrinking market. Still, oil demand is up every year now, but they're positioning themselves to be the best oil company, even if the overall market does at some point later this decade or in the 2030s starts to go the other way.
Now, the argument that BP makes in terms of keeping a lot of their operations in-house is that they have a humongous trading division, right? They are one of the biggest commodity traders in the entire world, and that they need all these parts of their business in order to help the trading arm, if I understand that correctly. So it's not as easy to just spin off stuff and get a little bit smaller and more narrowly focused. What part of that is true?
I mean, that's their argument to investors. The strategy reset didn't seem to overly please their investors. The shares were down on the day. I think people did want to see more, and we reported that Elliott was unimpressed, that they wanted to see more. So I would say that, at least some key BP investors, if not that particular argument, they want something more from BP to help drive the value of this company. And cut the debt, especially, which if they could sell something big like the convenience business, where they're selling things to people filling up at gas stations, that would go a long way to making their balance sheet better.
All right, Will, thanks so much for joining us. Will Mathis, energy reporter for Bloomberg News. So you're going to go down to this big conference down in Houston. Is the whole concept of peak oil, the discussion of peak oil, is that not even a thing anymore? Or we're back to drill, baby, drill and all that?
No, peak oil's done.
Done.
But I think it's more how cheap can you drive the cost curve down, whether that's through your own technological innovation or whether that's through lower taxes, lower federal land leases from the government, less regulation or taxes on, say, methane emissions. It's like, how cheap can you produce a barrel of oil? That's really the deal.
So are we not talking about going green anymore? Are those targets not a thing anymore? Are we not?
Well, in terms of their own operations, a lot of the U.S. guys wanted to hit targets for their own operations because it's economic. And then they did strategic moves into other forms of energy. So Exxon still has its own division, low carbon solution, that they are making acquisitions and doing stuff. Chevron has a hydrogen projects that's starting up, but those are very targeted, specific. And sometimes unique to the geology as well. It's not a broad-based thing, but like no one's getting into solar and wind from that basis, which is what it's a little bit different than what we saw in Europe.
So the whole peak clean energy thing, that seems to have peaked.
It's sort of like push out clean energy. So I don't think it's like anti. I just think it's not 2030. We're moving out. We're moving out. Okay. All right, coming up, we're going to talk to Sam Fazeli, Bloomberg Intelligence Head of Research, on the measles.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Sam Fazeli, actually in the office, shocking, in our London office, Queen Victoria Street, probably one of the coolest buildings in the city of London, the Bloomberg HQ. So if you're in the city, go check out the Bloomberg headquarters. It's really cool. They got a great museum there of all that artifacts and stuff like that. Not saying that Sam Fazeli's an artifact, but I mean, he's been around the block once or twice. He's a director of research for global industries, senior pharmaceuticals analyst for Bloomberg Intelligence in London. Sam, talk to us about what's happening here just in the U.S. We'll start first in the U.S. because we've got a new administration here and we've got some new leaders in the healthcare industry in government here. What's the feeling on global pharmaceuticals about this U.S. market here and how things may change?
Yeah, so sadly, Paul, I think one of the things that is deafening by its silence, is that the right phrase? Is what by their silence, is what the pharmaceutical companies are not saying. They're just not saying anything. So there's all sorts of stuff happening. One of the key things that happened recently in the past week, so let's focus on that time period, is obviously the cancellation of this, another cancellation of an advisory committee meeting. It's called VRBPAC. Alphabet soup, but basically it's the group that decides on a regular basis what sort of vaccines to use, who to use it for. There's two types of groups here. This is the one that advises the FDA, and the FDA needs to decide, and the group needs to advise who and what vaccine should be used or what strain should be used for the flu vaccine shots coming up. Right? So this happens around this time of year, coming up in September. I know it sounds like a long way away, but that's when they start the conversation. And the companies, Sanofi, Glaxo, CSL, any of these vaccine companies need that information to start building up their manufacturing, because it's not a mRNA type manufacturing you can crank like that. The later it comes, the higher the chance that the US will not get a decent volume of vaccines, or the companies produce at risk and they don't have any market to sell it to, and in the US at least. And that's a problem that's slowly brewing into a real issue, unless this delayed meeting of VRBPAC, or this advisory committee, is convened very soon.
Can they do it on their own?
Well, they're not allowed to communicate, or they're not allowed to put together a meeting without the blessing of the HHS, CDC, the FDA. So not really. I mean, scientists can get it together, but their word doesn't have much value.
So
yeah,
context, and we're told here context is important. Put into context what's happening here in the United States with the measles. Is this something, or is this just status quo?
No, it is something. So let me give you the stats that are right on the CDC's webpage. So measles 2024, 285 cases. Measles 2025, we are 2 months in, 164 cases. Wow. Right? So if you multiply that up, say it's running at 80 a month, this is going to be a year of 1,000. We've had those before, but the unfortunate thing is that this is in a couple of areas linked to a community that are pretty anti-vaccine, this particular group in Texas. And that's where, unfortunately, very sad, the latest death just happened, which was a child. Measles is an awful, awful virus. The problem is, it's not just at risk today, but it wipes out 70, 80, 60% of your immunity that you had to other stuff. So you've spent all your life gathering immunity. Once you get measles, it cleans it out. So you're then susceptible to a whole bunch of other stuff. It is not a good disease, and we can't keep minimizing it. And unfortunately, that's a little bit of what's happening there.
Well, Sam, to that point, if you had all your vaccines, and for kids, they get the MMR, right? Measles, mumps, and rubella shots, etc. Are you good? You need to like check your vaccination status. Like, does it wear out at some point?
Measles is one of those funky ones in that it itself, in the vaccination, it seems to be for life. But let me give you another statistic. Of the 164 cases so far in 2025, 95% are unvaccinated or unknown. Now, the thing is, no vaccine is 100% protection, right? And the thing is, you need to get to that thing. Remember the herd immunity? And it worked with measles. We went from 1 million cases a year to these numbers. But if we let our guard down, which I'm worried is happening now, it's a problem. So, but there are more interesting and hopefully not more interesting, but more positive things to talk about, which is the evolution of the obesity market, if you want to go and talk about that.
So, isn't
In case
AbbVie
you don't
getting,
want to be bummed out.
AbbVie getting into that business?
Yeah. So, they came out of the blue today and announced they've done a deal with a company that not a lot of people talk about, Gubra.
Oh, boy.
In Denmark. Denmark has got this huge ecosystem that was built up out of Novo Nordisk. So these are the same type of people as put together the Zealand, another pharma company. This is a biotech company. They've done a deal, $350 million up front for a drug that's in phase 1. So the obesity juggernaut continues, and this is a new mechanism that's not on the market yet, but there's lots of studies and data showing it's a good mechanism and could be complementary to the GLP-1s that we all know about. And then, of course, then Lilly came out and said, which it fits with the rhetoric of trying to onshore or reshore manufacturing to the US, another $27 billion of investment in manufacturing. Some small molecules, but 4 sites they're putting together. One of them will be focused on injectables. What do you inject?
Yeah.
Zepbound.
All right, Sam, we love you. Thank you so much, Sam Fazeli of Bloomberg Intelligence, joining us there. We'll get him back every week to break down what's happening in the healthcare industry. So for all our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on Sirius XM, channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The second hour of Bloomberg Intelligence starts right now, with the market still a little bit lower on the day. The S&P off 0.3%.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live on our interactive broker studio right here in Midtown Manhattan. Also check us out on YouTube.com as well. We got you covered for the hour. Ira Jersey will be joining us. It is a big week economic front. We got State of the Union. We also wind up having Jobs Friday. I can't believe it's Jobs Friday already. Ira Jersey will help us break down what to look at. Plus, Steve Mann of Bloomberg Intelligence will give us the latest on autos as we head into the tariff world, potentially tomorrow. 25% tariffs on Mexico and Canadian imports. Christina Hooper over at Invesco will join us for her outlook on the market. Plus, Ashley Furlong is Bloomberg Health reporter. We'll talk about the U.S. and its withdrawing from the global healthcare system at this pivotal time in the world. But let's kick it all off for you right now. Here is John Tucker with your Bloomberg Business Flash.
All right, let's start with the data we got last hour. Manufacturing edging closer to stagnating in February as orders, production, and employment all faltered. Now, worsening the situation, the cost of the stuff that they buy, that's shot up to the highest in more than 2 years. And right now, NVIDIA doing a lot of the damage to some of the major indexes, the worst performing stock right now in the S&P 500. The Bloomberg Mag 7 Total Return Index, that's down 0.7%. S&P 500 right now, 11 points lower, but it's down 0.2%, 59.42 on the index. The Dow, 38 points lower. The Nasdaq 100 right now, 37 points lower. That's down about 0.2%. And the 2-year yield, that's actually higher, up 2 basis points, 4.01%. The 10-year yield, a little change right now at 4.20. And meantime, ahead of the tariffs tomorrow, Mohamed El-Arian, the chief economic advisor at Allianz, says businesses may be putting their plans on hold until they get some more clarity.
There's energy issues, there's immigration issues, there are trade issues, there are public sector issues, including public sector contract, there are regulation issues. So you're trying to absorb all this, and what we've seen is sentiment has come down and there's been a wait-and-see attitude.
And Allegro Microsystems drawing takeover interest from its larger competitor on semiconductor. That's according to our sources. Allegro rising just about 22%. That would be the biggest gain since 2020. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. So head over to youtube.com/Bloomberg Podcast Live, and that's where you'll find us. Here's John is just reporting a little bit of red on the screen here. Let's see where the action is under the hood. We do that with Isabel Lee, Bloomberg's cross-asset reporter. Isabel, what are you looking at?
Capri shares are edging higher by almost 7%. It has paired some of those gains, but still, this comes as the company moves closer to a sale of Versace to Prada, and that's as much as $1.6 billion. And Prada shares gained 4.1% in Hong Kong. That's where the stock is listed in 2011 in a nod to the importance of the Chinese market. We know that a lot of these luxury brands really hang on to the Chinese market for a lot of their revenues. And a potential acquisition of Versace would allow Prada to create a larger Italian player that will compete with LVMH, Kering, etc.
Don't look at me. I'm not buying Prada or
You're not
Versace.
a Prada or Versace
No,
or
discount designers. But even Versace discounted is a no-go for me.
No.
It's just too expensive.
John, Versace?
On 14th Street, they have some great Versace
and Gucci
Weren't
bags.
you the one who wanted the Bruno
Gucci.
Cucinelli scarf for Christmas?
Wow.
Yeah.
Unknowing that it was
Fancy.
like $1 million.
I got it.
He didn't get
Oh,
it.
wait a second.
He did not get a Bruno Cucinelli scarf for Christmas. All right, what else are you watching?
Celsius, it's edging higher by 4%.
It's the energy drink maker,
Yes.
right? Okay.
And earlier we talked about who has tried it in their lives and who has not. I have not. Maybe soon. But they named the former PepsiCo executive Eric Hansen as their president and CEO effective March 24. And Hansen has nearly 3 decades of experience in the industry. He was most recently senior vice president at PepsiCo, where he managed just a portfolio of brands representing around $3 billion in annual revenue. Recall that PepsiCo has an 8.5% stake in Celsius. That happened in 2022. And recently, Wall Street has reduced their estimates for Celsius after PepsiCo reduced Celsius inventory. So mixed news there, but shares are reacting positively today.
Yeah, I'm just going to go look at I'm just going to go look at the 8K and see how much stock he's getting in this thing. So I'll get back to you later.
Okay, all right, he's going to get back to us on that. That's great.
Wow.
And then Kroger, you're also watching Kroger, right?
Yes, another people mover shares edging lower by 1.2%. So Kroger is the largest U.S. supermarket operator. I have not been into one because I order my groceries, but they're replacing their CEO, Rodney McMullen.
You live in the city. That's what happens.
Thank you. Following an investigation into his personal conduct, but the company stressed that it's unrelated to the company's financial performance or any Kroger employee. All they know is it was, quote, inconsistent with Kroger's policy and business ethics. This is kind of sad news because McMullen has risen over the ranks in Kroger's. He joined in 1987. He was a part-time stock clerk and really just made his way up until he became CEO. But now Rod Sargent, the lead director, is named chairman and interim CEO effective immediately.
All right, here's the comp for the new Celsius, dude.
Okay.
Salary, $700,000. Aggregate $1.15 million of restricted stock as a performance bonus. And he's going to also receive, upon the commencement of employment, $1.2 million of additional restricted stock. So that's
He can buy
okay.
the scarf.
That's okay.
Yeah,
he
he
can
can definitely buy the scarf.
Yep.
Yeah,
And
definitely.
he started
that
off
stuff.
as a part-time clerk at Kroger.
Yes.
So there's hope for all of you out there.
Yeah.
Bagging and,
Well, that's Paul's second career, right? Third career. The
Well, he's
greeter at
going in
Walmart.
reverse.
He's
He's
gonna-
going from a superstar
You
position
just
to...
wait. You just give him 20
I'll be a
years.
superstar greeter
Yeah,
at
yeah.
the
You know
Walmart
it.
in Brick Township.
He'll be the head of all the greeters. All right. Thanks so much, Isabel, for joining us. Isabel Lee, Bloomberg Cross Asset reporter. All right. It is a very busy week. We got the ISM manufacturing data that already disappointed, and then we push ahead to Jobs Friday, and there's a whole bunch of stuff in between as well. Ira Jersey is Bloomberg Intelligence Chief U.S. Interest Rate Strategist joining us now. What's your focus for this week, and how is that reflected in the bond market?
Well, it has to be the payrolls report on Friday, but we do have some other data that we're going to get in between that, including the ISM services data. Just this morning, just an hour or so ago, we had the ISM manufacturing report with prices going up, employment and new orders going down. That's like a bad sign for the economy. And, but services really has been what we've been focused on so far because that's been the healthy part of the economy. So let's get through Wednesday's ISM report, and then we're going to focus very squarely on payrolls.
And Ira, I think just over the last couple of 3 weeks, the various fund managers that we speak to on this program, I've sensed a greater concern about economic growth Are you hearing that too from your clients? Are you seeing it in your treasury market?
Yeah, so there are a lot of people who are concerned that economic growth may be slowing and rolling over. Friday, we had the consumption data. So, we always focus when we get the monthly PCE, the personal consumption expenditures deflator. That's the inflation measure. And, we always shorten that to PCE. But really, PCE also includes consumption, right? It's a personal spending and income report. And part of that is personal consumption. And what you saw was personal consumption, particularly of services, which had been growing very quickly last year. That looks like maybe in December and January, it started to flatten out a little bit and isn't growing as quickly as it was. So there are people, and including myself, that are a little bit concerned that maybe the consumer has had enough and they're going to be slowing their spending, maybe because of uncertainty, maybe because of continued price increases. But generally speaking, there are people who are worried about that. Where you really see that and it gets manifested, Paul, is in TIPS real yields. So when you look at 5-year TIPS yields, those have come down about 60 basis points over the course of this year. Part of that is because inflation expectations have gone up a little bit due to tariffs, but really that in a big way, I think, is a reflection of the poor growth that some people suspect might be coming down the road.
Now, last time we talked, you were looking for about, I think it was 4.13 on the 10-year. This was a level that was going to shake out a lot of positions. We're now at 4.20. Do you think we get to the 4.13 level this week?
Yeah, I suspect that we will. If we stay above that in terms of the 10-year yield, 4.13, then that means that we're probably going to consolidate and stay in a range between 4.13 and maybe 4.3%. But if we break through that, I suspect that there's a lot of stop losses, particularly of shorts, that are going to wind up covering those shorts, and that could push us down pretty quickly, down below 4% once again. That wouldn't completely surprise us. In fact, I'm going to stick with what we said starting last November, that we thought that we'd be in a pretty wide, like 90 basis point trading range for the course of this year. And so I think we're going to test the lower bound of that over the near term, unless we get a big upside surprise on payrolls. And that doesn't seem to be in the cards. When you look at some of the data from about a month ago, from mid-month, I should say, in February, you had claims data start to rise a little bit. You have some other anecdotal evidence like the ISM manufacturing employment report that was negative. So all of that's pointing to maybe a little bit of a softer job market. That's not something that I was expecting going into the year, but certainly we have to react and be prepared for these shifts in the data.
All right, Ira, thank you so much. We appreciate that. Ira Jersey does all the interest rate strategy stuff for Bloomberg Intelligence from Princeton, New Jersey. All right, tariffs, it appears like they're coming. And that's going to be an issue for a lot of industries out there. One of the more prominent industries that's going to have to deal with that is the global auto industry. Steve Mann joins us. He's a global autos analyst for Bloomberg Intelligence. Steve, when you look across the auto business, how are the companies that you cover, how are they kind of positioning tariffs and risk of tariffs on their business?
Oh, I think the big three is actually in a better position. Big three and then actually Mazda are in the best position. The way we look at it is take a look at the, what Trump negotiated in his first term, which is the U.S., Mexico, Canada free trade agreement. And part of the agreement stipulates that, these automakers need to actually have at least 75% of the vehicle, the value of the vehicle, be produced in North America. And then the big three and Mazda has actually done a pretty good job in following that rule. But if you look at the Europeans and some of the Koreans and the Toyotas, they actually produce a lot of vehicles in North America with, less than 75, some at 0% local content. I think those vehicles or brands would be at risk of higher tariffs.
Just focusing on Ford for a second in particular, just as an example, the stock is down 15% basically since the end of November. So is it pricing in tariffs in a way that it shouldn't, I guess?
It's not so much of tariffs for Ford. I think Ford is having some issues with earnings. As you can see, actually, in the second half of last year, and in the second half of last year, their EV sales, in terms of profit, EV profits have plummeted in the second half, likely to fall this year as well. If you look at their sales in February and January, their ICE vehicle sales have actually not done very well either. So I think the market is actually anticipating weaker earnings for the company this year.
So what do you think is going to happen to the price of an automobile in the United States when these tariffs hit?
Yeah, we actually think that our view is that I think Trump is going to give at least some reprieve for the U.S. automakers and the ones that actually meet that 75% local content rule, and but they're not fully compliant. So there will be some costs. Some vehicles that are produced in North America don't meet that local content rule. So we've done some analysis, and we estimate that at least $3,500 impact to costs if these tariffs do come into play. The question is it easy for them to pass it on to the consumer? We doubt it. Sales this year is not going to be strong, and it's going to be very difficult for automakers to actually pass on any price increase. So they're going to have to eat that.
Is that factored in to say their operating margin?
I don't think fully. I think even the automakers were pretty unsure of where this is heading. If Trump is going to implement these tariffs. But I don't think it's fully baked in yet. Because the other thing we haven't looked at, and I think the industry needs to come to realize is it's not just the short-term costs is going to be impacted. If the automakers have to shift production back to the U.S., the investments is going to be huge. We're talking about billions of dollars just to move equipment back and maybe set up new plants in the U.S. To satisfy or to minimize these tariffs impact.
Steve, while we got you here, let's talk Tesla. I see Morgan Stanley kind of raised its rating here. The real value, Morgan Stanley says, in Tesla lies in its robotics ambitions. What's the feeling out there in terms of the market in Tesla right here?
I think a lot of the market doesn't realize is that a lot of the weaker sales that you're seeing from Tesla, it's actually car buyers holding off in anticipation of the new Model Y. Oh. So far, what we're hearing is that demand is strong, especially in China, for the new Model Y. They just started shipping the new Model Y this week. The other thing that was interesting is, we're hearing a lot of feedback on the full self-driving feature that Tesla just offered in China. And I think the drivers are testers and car buyers over there are really impressed with how well FSD is doing in China. So that's going to be a good, strong selling point for Tesla, especially in China, one of its biggest market in the world.
Unless it gets caught up in retaliatory tariffs, right? I mean, there's always that lever to pull as well. All right. We really appreciate it. Thank you so much, Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst, joining us there. And we kind of wait from D.C., right? And potentially around 1 o'clock, an announcement. Maybe it will be TSMC announcing $100 billion in chip investment plans in the U.S. over the next 4 years.
All right. I mean, they like big announcements, but nice round numbers, 100 billion, 500 billion. So it's all good as part of this, I guess, reshoring, friendshoring, all that kind of thing.
Well, but remember, back under President Biden, there was the CHIPS Act, right? And that legislation back in 2022, when it was passed, led to TSMC winning $6.6 billion in grants to support 3 plants in Phoenix. So let's see where that circles. And then we also realized just because you have the money doesn't mean it's easy to get done. Look at Intel and then having to rethink building chips, or just how they're going to build out and how much money they have to spend going forward. Anywho, much more coming up. Christina Hooper, one of the best chief global market strategists at Invesco, will be joining us for her outlook on the markets when sentiment is decidedly not great This is my professional take.
There
It's
you
not
go.
good. Look at that bull bear sentiment index. And then Ashley Furlong is Bloomberg Health reporter. She'll join us in the Bloomberg Big Take story that the U.S. is withdrawing from global health right now at a very dangerous time. Taking a look at the market here, you got the S&P off by 0.1%, the Nasdaq off by 0.3%, Dow Jones Industrial Average off 0.1%, as that U.S. ISM manufacturing data came in much weaker than estimated, particularly the employment number. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is the Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Major averages right now mixed to little change. Measure of volatility, that is elevated. We'll start with the VIX. Right now, just about 20. The ISM Manufacturing Index out this morning, showing orders, production, and employment faltering. At the same time, the cost of materials jumping to the highest level in more than 2 years. And then we'll get the biggest reading on the biggest part of the economy, the services index. That is out come Wednesday. Most active, NVIDIA right now. It's also the worst performing stock in the S&P 500. NVIDIA has the third biggest weighting in the S&P 500. Number one, by the way, is Apple. That was down about 0.1%. Number two, Microsoft, down about 0.5% right now. It is worth noting that if you look a little deeper, the S&P 500, 319 stocks are actually higher. 178 are lower right now. Once again, the S&P 500, little change, 59.55 in the index. The Dow Jones Industrial Average, 11 points lower. The NASDAQ 100, that's turned positive. That is up right now 40 points, a rise of 0.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find it. It seems like, again, I was mentioning to Alex earlier that in the last few weeks we've heard from professional investors that there's growing concerns maybe about the U.S. economic growth and the exceptionalism thereof, and if so, what do you do with your investments? Christina Hooper joins us here. She is Chief Global Market Strategist for Invesco. Christina, how do you think about U.S. economic growth over the last several weeks? Has your outlook changed at all? And if so, how did you maybe change kind of the way you're looking at investment opportunities?
Well, Paul, Alex, it's great to be with you. My outlook hasn't changed much. Our expectation when we put out our 2025 outlook in November was that we're likely to see better performance from developed markets ex-U.S. in 2025. And so that is playing out. The U.S. has been doing so well for so long, and this seems to be a time in which we're likely to see key drivers like greater monetary policy easing and lower valuations supporting other markets. So my view is that we're likely to see some hiccups. It doesn't mean we're going to see a dramatic downturn, but we do have as a frame of reference the 2018-2019 tariff wars, which were negative for U.S. stocks. So we want to be careful there.
So does that mean, okay, we had someone else on the last hour that said buy the dip. It sounds like it's more let it play out and see what happens by stealth elsewhere?
So I think first and foremost, it's about rebalancing. Most investors are likely overweight U.S. equities and underweight European equities, UK equities, EM equities. So this is an opportunity to rebalance. U.S. stocks have had a great run over multiple years. And it's about, in doing so, in rebalancing, one is going to have an overall valuation on one's portfolio that's lower. That might be less vulnerable to some of the turmoil and uncertainty that we're seeing right now. And so essentially maintain exposure to the U.S., but this is not a time to be overweight the U.S., in my opinion.
Interesting, because I'm looking on a year-to-date basis, the S&P 500 up about 1%, but the stocks Europe 600 price index, which I think is kind of the broadest view of European investing, that's up 11% year-to-date. Do you expect that to continue, Christina?
I do think so. We have some powerful drivers. First of all, we've got, potentially significant ECB easing this year. But beyond that, what we have is low valuations, and we have economic surprise. It's positive. Sentiment has been pretty negative on European equities, and they're exceeding expectations. So I think this should be a good year for European equities. And I think it could very well be a good year for UK equities, Japanese equities, and in fact, EM equities as well.
But what about the whole tariff thing? Because that's going to hurt everybody, right? So is it just that because valuation is so much lower in Europe and the UK than the US that it can absorb that kind of hit?
Well, I think that's certainly part of the story. Also, you, of course, have those other drivers that I think can soften the blow. For example, additional easing. If we look at emerging markets, central banks, more easing was expected last year than we got. So I suspect that is what will come this year. We had to wait a little bit, but I think this is probably good timing and should be supportive of any kind of headwinds created by tariffs.
Walmart recently reported earnings, and people look to Walmart. It's just a great gauge of the U.S. consumer here. What did you see from Walmart? How do you feel about the U.S. consumer here?
So Walmart was, I think, very rational and reasonable in saying that we don't know exactly what's going to happen this year. There's an awful lot of uncertainty. And I think that's the reality, that the consumer has been quite resilient, but we don't know how things play out this year. And I think that makes sense. The U.S. consumer is coming under greater pressure. Sentiment is down significantly. And we saw on Friday that personal spending was down. We have to be concerned that there are pressures. Now, having said that, they could be very short-term in nature, since they seem to be driven largely by tariffs and the potential for tariff wars. So if this were to be behind us, it could be very similar to what we saw in 2018, 2019, where as soon as the bulk of the tariff wars are over, there is a resumption in not just improved sentiment on the part of consumers and businesses, but improved spending.
What are the most typical questions that you're getting right now from clients based on this global view that you have?
Well, are we going into a recession in the U.S.? And I think that's only been amplified by the Atlanta Fed GDP Now estimate, which has shifted from growth expectations of over 2% to now a negative growth in the first quarter. My answer is that we need to wait and see. It's unclear. Our base case certainly has not been for a recession this year, but we are seeing a deterioration in economic data. So we want to follow this very closely. Now, it could very well be that we do see growth in the first quarter. Keep in mind that the Atlanta Fed GDP now there is real time, so it can easily shift. But I do think we want to be more on top of this, more cognizant of every data point and what it might be telling us. We want to find those canaries in the coal mine right now.
Yep. And you're not alone in that. Michael Ferroli over at JP Morgan just cut his first quarter real GDP estimate from 2.25% to 1.5%. So like it's moving really fast. Christina, thank you so much. Christina Hooper joining us from Invesco. Always wonderful to get your perspective. Here at Bloomberg Intelligence, we love to dive into the Bloomberg Big Take story. It's the big themes in the markets and the economy. And we take a lot of time to drill down into the meaning into those stories. And today's focus is on healthcare. Ashley Furlong is Bloomberg Health reporter, and she joins us now about the U.S. withdrawing from the global health world at a very dangerous time. We were just speaking with Sam Fazeli about the difficulties in getting a flu vaccine roadmap for next year. On a global stage, it looks even more different. Ashley's joining us now. Ashley, walk us through, first of all, I guess, tell us why the U.S. is so important in the global healthcare industry.
So the US plays a sort of a much larger role than many other countries in global health, and whether that's from funding, it's the largest funder to the World Health Organization, and it's pulling out of the World Health Organization. It funds many programs for HIV around the world, many programs around the surveillance of infectious diseases, whether that's things like measles, which we're seeing in the US, to emerging potentially new pandemics. So it's the US sort of pulling back at all in the global health space, whether that's in financing, whether that's in terms of its researchers, whether that's in terms of data sharing, is really a significant problem, not only for the whole the rest of the world, but also for the US itself.
So how are other countries planning on, I don't know, stepping up, filling the void, making some changes here?
They haven't really said yet, and I think that's what's really scaring people, is that we haven't really heard much from other countries saying that we'll fill that funding gap. And what we're talking about are actually quite small numbers. So, we're seeing this measles program, the surveillance program for measles, potentially being cut, and that's only $8 million a year. Now, that's obviously, a very small amount of money in the bigger scheme of things, but without that program, we're not sort of monitoring for many types of infectious diseases, whether that's RSV, whether that's measles, whether that's COVID, and we haven't really seen other countries step in. There's obviously big questions about whether organizations like the Gates Foundation might step in and fund, increasingly step in and fund global health organizations or global health programs, but we haven't heard any concrete actual promises from either countries or from other organizations.
so far, what has the U.S. actually done and withdrawn or pared back funding? Like, what's the reality right now?
It's across the board. So it's pulled out of the World Health, well, planning to pull out of the World Health Organization and already stopped sharing data with World Health Organization officials. Last week, we saw them share some data on influenza, but for the previous couple of weeks, it hadn't shared any of that data, nor had it shared data on avian flu, which is obviously, you know, a sort of rising worry to many scientists and public health experts. It's pulled back funding for HIV programs around the world in form of PEPFAR. It's pulled back funding from USAID, which is, you know, across the board, multiple global health programs in many, many different countries. And then we're seeing sort of less sharing of infectious disease data, and that's really important for things like, you know, manufacturing vaccines to know what kind of, you know, strain you want to add into the new flu shot for the coming winter season. You know, as we said, infectious disease data on measles. So we're seeing, you know, just sort of a complete almost silence in many of those aspects.
The Robert F. Kennedy Jr., U.S. Secretary of Health and Human Services, what have we heard from him so far?
We haven't heard that much. We've seen, well, since the inauguration, we haven't heard, you know, him saying that much in terms of he wants to cut this or he doesn't want to, he's going to keep this program. We did hear him say that he wants to focus increasingly on chronic diseases rather than infectious diseases, and that's obviously very worrying for people working in the infectious diseases space because, you know, those are things that you can't sort of stop monitoring. And we have seen 2 key vaccine meetings cancelled or postponed in the last couple of weeks. And one of those you might have heard about from Sam, which is, you know, the advisory committee on vaccines. And they sort of say, these are the vaccines you should be getting. And these are the, you know, this is what children should be getting. This is what adults should be getting. And that meeting's been postponed. And then another meeting was recently also cancelled, which decides on and tells manufacturers, vaccine manufacturers, what they should put in their flu shots this year.
All right, well, on that good news, we're going to leave it. All right, thanks so much, Ashley. Ashley Furlong, Bloomberg Health reporter, joining us there. Check out that Big Take story on Bloomberg.com/Big Take or on the terminal as well. All right, coming up, we're going to talk about jet fuel demand in our weekly Bloomberg BNEF segment with Claudio Lucas of BNF.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, they are all lower. They've been bouncing all over the place today. S&P 500 down 26 points. That's a decline of 0.4% at 59.28. The Dow Jones Industrial Average now is down 191 points. That's down 0.4%. The NASDAQ 100 is 79 points lower. That's down about 0.4%. So I think we can say groping for direction. Most stocks, they were actually higher in the S&P 500. Let me check that right now. The advanced decline line, 278 stocks higher, 221 are lower. And the lower stocks, they include NVIDIA. Some of the biggest weightings are the ones that are down. NVIDIA shares, they are down 5% right now. Apple is down. Also, Microsoft, that was down about 0.8%. Now, the tariffs set to go into effect tomorrow, unless, of course, they're rescinded at the last minute, which is always a possibility. Troy Gayeski at FS Investment Solutions says, after a period of uncertainty from tariffs, the Fed may cut twice this year.
You know, our base case this year has been 25 to 50 basis points of cuts. We still think they're on pace to do that. Obviously, they're frozen for the time being to see which tariffs go in effect, what that impact is on inflation, what the growth picture looks like. But as you know, the labor market is gradually weakening.
And the 2-year yield right now, a little changed. We're at 3.98. The 10-year yield, 2 basis points lower. That is at 4.18. Loved this story from the Wall Street Journal. School districts around the U.S. spending tens of millions of dollars to expand and revamp high school shop class for the 21st century.
Now we're talking.
They're betting on the future of manual skills. Even if you're a high school student and you get the opportunity to take shop, you got to do it. Even if you plan on being, I don't know, like a Paul Sweeney investment banker.
Yeah, and I did not do that.
Because the
That's
stuff
why I
you
had to
learn, you
people
always have with you. You can fix up your house, build your own
So,
bathroom.
You say that, but when we were doing all the tours of middle schools and stuff for my daughter who's going to 6th grade, they all had shop classes.
Great.
Like that, like a full-fledged, they might do different things there, but you know, it's pretty cool.
That's very cool.
Yeah, I know.
I mean, the
And
shop.
she's an only child, so she's gonna need to know how to do all this stuff when like I need her to set things up for me when I'm old.
Send her down. I'm not finished with the bathroom yet.
Okay.
Okay.
Well, I'm all into that. All right. This is, what are we? Bloomberg Intelligence. I'm
there you
Alex
go.
Steele alongside Paul Sweeney and John Tucker. Happy Monday, everybody. So every Monday around this time, we check in with the folks over at Bloomberg NEF. They are a research arm of Bloomberg that talks about commodities, power, transport, industry, buildings, ag sectors, finance, government, navigating the change as we move through this energy transition. Like we're going there. It's just a matter of how we get there and how long. Well, joining us now to discuss is Claudio Lubis, Bloomberg NEF lead downstream oil analyst. So that just basically means he covers the refiners. Claudio, it's great to see you get your perspective. Just broad strokes, how are oil refiners doing right now?
Well, thanks for having me, Alex and Paul. I think oil refiners in general are definitely looking into the effects of the tariffs, should those happen. Because especially for U.S. oil refiners, for example, any impact on tariffs from Canadian or Mexican crude flows would potentially affect their run rates, which can in turn trickle down into passenger or higher fuel costs for consumers.
Claudia, talk to us about jet fuel here, aviation fuel. How's that market doing? How's the demand there?
Jumping right into the jet fuel.
Yeah.
All right.
Yeah. So I think just pulling it a little bit back, in the grand scheme of things, when we look at the long-term trajectory for oil demand, for example, under our base case scenario, we expect total oil demand to peak around 2029 before entering a structural decline to 2050. And oil use in the road sector for now, which accounts for under half of oil consumed globally, will peak in 2027. So this calls into effect the economic viability for oil refiners who operate predominantly to produce either diesel or gasoline. However, a silver lining here is that refined oil demand from the aviation sector will continue to be resilient in the long run. And we see total jet fuel consumption continuously grow all the way in the foreseeable future with no peaks, hitting a figure of around 11.5 million barrels per day by 2050. And for context, this is 75% higher than levels last year. And so this demand profile, it's significantly different and much more resilient than the other bearish sectors like road transport or marine, which means for fuel producers like Marathon, Valero, and even Sinopec in China might have to adjust their product yields in the long run to adapt.
Interesting. Okay, so basically you see oil demand then peaking, say in 2029, and that comes with the majority of oil products also with the exception of jet fuel. But I thought the whole point was that sustainable aviation fuel was at some point going to take off, and that was going to wind up denting jet fuel demand. Is that not in your forecast?
Well, that's an interesting point. And the important thing to note here is that without stricter policy interventions or a drastic breakthrough in low carbon aircraft models, airlines and the aviation sector will continue to become even bigger polluters in the years ahead, even with the inclusion of sustainable aviation fuel. So from an emissions perspective, we estimate that total emissions from flights may rise to around 1.1 gigatons by 2030. And that's up 20% from figures in 2023. Now, the use of these SAF, or sustainable aviation fuel, will likely scale up, and this can soften some of the blow on emissions growth in the coming years. SAF, or sustainable aviation fuel, will likely scale up, and this can soften